If there's one word to describe the real estate market in 2023, it's meh. Now as we enter the new year, will 2024 be any different? And if so, how different can it be? Happy New Year everyone! Thank you for joining us on our 2024 predictions video. Now, in a blink of an eye, we've been doing this for 4 consecutive years, starting from 2020. Now, for the new year, we're going to be trying out something new. For every video that we put out, we're going to put in a cash prize. And for this video, because nobody managed to win the cash prize from the oversupply video, we're going to roll it over. And now the cash prize to be won for this video is $200 in cold hard cash. And what you have to do to win that money is just 2 things. Number 1, subscribe to the channel. And number 2, put down into the comments just 1 prediction that you have for the new year. 2024. Of course, it has to be real estate related. Now, I look forward to reading your comments and to give out that prize. And that's how we've always done it. We're going to take a look at our predictions for 2023 to see how we fared and take the opportunity to take a look at some of the data behind those points. And that is very important because that's going to be the foundations of which we build into 2024. Now let's get right down into it. We're going to start off first with, I'm going to wrap the first two predictions together. The slowdown in volumes as well as the slowdown in price index increments. And now let's see the data behind it. The end result was that this was pretty accurate. So first things first, let's take a look at the volumes, okay? So I got this table from the MAS Financial Stability Review 2023, or just published in the later part of November. A very, very good read for those of you who are interested. But for those of you who don't like reading such stuff, I'm going to run through the TLDR of which later on in the video. So as you can see, the transaction volumes have moderated to pre-COVID levels, as you can see over here, quite similar to where we are in 2019. And the reason behind the slowdown in volumes from the eyes of an insider, somebody who is in and around the market on a regular basis, is the fact that number 1, the euphoria, the FOMO of the post-COVID period has sort of died down, primarily also because of interest rates. But other than interest rates, which is the obvious difference between the period in 2020-2021 versus now, it's also the fact that prices have came up quite a fair bit during the 2020-2021 period. And as prices have climbed, interest rates coming up has created sort of a pullback in terms of loan affordability because the banks utilize a high interest rate, higher than MAS stipulated interest rates, right? So for the benefit of those of you who don't know what I'm talking about, so MAS stipulates a 4% interest rates for the stress test in your TDSR calculation, telling you how much loan you can take. With SORA spiking, interest rates spiking, the banks have actually utilized 4.7 to 4.8% to calculate your TDSR, how much loan you can take. Now, so this with an increase in prices followed by a drop in loan that you can take, right? Of course, unless your income has come up. If not, with higher stress test interest rates means your loan comes down. So now there's now a gap between what the seller is asking for versus what buyers are, number 1, willing to pay, number 2, can afford to pay because of the stress test interest rates, which later on in the video I'm going to talk about the likely impact of all of this with the upcoming or the commonly accepted consensus that interest rates are going to taper off, if not come down slightly in the later part of 2024. So now this explains, and which is why it was pretty obvious to me that this is going to happen. The very first predictions I've done, basically it's the gap that exists in the market right now, a seller having to ask for a high price, also because the seller likely has to buy something. For that seller, if his loan is already quite low, then he has to make up for it in terms of the asking prices. And As we say, interest rates is the oil, the grease in the gears of the real estate market. And when interest rates are elevated, the gears slow down, the volumes slow down. And with volumes down, quite naturally, the rate of increase of prices would then slow down. And to be fair, the government couldn't afford for the rate of increase to be consistently at that rate, which is why they've came up with cooling measures after cooling measures. I didn't expect the government to have to step in this year to implement a cooling measure, but they did, primarily to penalize the foreign buyers because they noticed that they are coming in and setting benchmark prices in the CCR. And as one of my previous videos I did mention, because there's also going to be a lot of new launches coming in D1, District 1, your CBD area, and those launches will start to fetch 4,000 PSF thereabouts. If you go to the penthouse, maybe 4,005 Sea View. And so the government want to preemptively hold back all those benchmark prices from happening until they sort of figure out this supply-demand dynamics a little better. And it hit the spot exactly because we expected launches like Newport to come up, Marina Bay, the launch to come up, but all those were postponed right after the implementation of the new cooling measures that bumped up foreigners' ABSD rates. Okay, so now the rate of increase has slowed down to somewhat similar to the pre-COVID period. Okay, similar to the transaction volumes also slowed down to the pre-COVID period. Some of you may think that, wow, things are slowing down, but to me, the data also suggests that things are just reverting back to normal. The hype is over, things are back to normal. Do I expect them to come down? I really don't think so, considering the supply dynamics to the market, which I will talk about slightly later on in the video. So this chart may not be so familiar to most of you because most of you would probably be more familiar with this chart, which is the private property price index chart. What they have done is to break down the price indices based on the region. Okay, we have the OCR that is still coming up, the RCR that is also coming up, and if you compare the rate of increase, RCR's rate of increase is actually steeper than that of the OCR. The reason why I primarily put it down to the fact that there's a lot more TOPs in the RCR, and when developments TOP and when they go into the sub-sale market, they tend to fetch a higher PSF as opposed to their resale peers. So with the OCR also have quite a fair bit of TOP, but RCR's TOP developments are fetching quite a fair bit higher price than that of their OCR counterparts, which explains the sharper rate of increase for the prices over here. Now, for the OCR, it's actually seen a dip in the property price index. Now, number one, the immediate thing that you may put this down to is, of course, the ABSD increment from 30 to 60% for foreigners. But actually, if you look at the percentage of foreigners that take up buy properties in Singapore, that figure is not overly big. Okay, it stands in the single digits. I believe it's at from 6% down to 3%. All of that data stipulated in the Financial Stability Review. So you can go in and see. Now, what explains this drop? Of course, you can attribute it a little bit to the withdrawal of foreigner demand from the market, but that's being only single digit. I don't think that's a significant factor. I put that factor down to the fact that there's not that many CCR TOPs in the market. Okay, and so they have primarily been trudging along with all the resale PSFs. So now, but the interesting thing is this year, moving forward, we expect to see a lot more CCR TOPs, right? Such as our Leiden Green, we have Wilshire Residences, you have, I believe, here in Holland sometime next year as well. So the new batch of supply into the CCR is going to hit its TOP really soon, and that's an interesting data point that I would very much be monitoring because they are one of the first few supplies into the CCR with the newer kind of builds, right? So you have your 700 square feet 2-bedders, and then you have your 900 square feet 1000 square feet 3-bedders, as opposed to the supply of O that tends to be a lot bigger, which is why for those, their PSFs sometimes hover up and down, because a lot of all these CCR developments tend to be quite boutique as well, so they see huge fluctuations in their PSFs, okay? And so all of this kind of explains the dip I see over here. Is it cause for concern? I would say it kind of depends, okay? Again, another explanation here is that the CCR is quite different from your OCR and RCR. And how do I explain it is this. What you get in the OCR, be it north, south, north, right, northern part, eastern part, western part, somewhat the same lah. Okay, of course, depending on where you want to stay or where you go, people have preferences here and there. But you go into the OCR, it's primarily the same thing. Then you go into the outskirts RCR, also primarily the same thing. Or Queenstown, the makeup is quite similar to, say, your Bishan, mature estates, expensive HDBs, some condos. You move down into your Eunos, Marine Parade area, mature estates, right? Some old wealth over there. But in the CCR, it's a very different creature. The CCR is, while not that big, is made up of a lot of different parts, okay? We have our more blue chip CCR stuff, like your Balmoral area, your Chancery area, basically the areas that have your popular schools. And then you have the areas that are very speculative in nature, a lot of foreign demand, okay? Another blue chip CCR area is your Ardmore area lah, okay? Then we have the somewhat other areas of the CCR, you know, you have your Sentosa Cove, and then you have your CBD, your District 1, District 2, so for those of you who watch the oversupply video, for those of you who didn't, I'm going to put that link in the description and also somewhere here. So the District 1, District 2, which also all of these are wrapped up in the CCR, and some of them traditionally don't do well, right? The explanation of which is those areas don't have the organic demand. So again, right, while you look at all this, the general data point for the CCR, do also note that the CCR is broken down into a lot more minute parts, right? A lot of nuances into investing and buying into the CCR, okay? So now moving on to the next one. And for my next prediction, I predicted that rental prices will stabilize. And this turned out to be very, very true, as we can all see. Again, this was quite a simple one to predict because of the sheer number of TOP units that were coming onto the market. Here's a quick look at the data behind it. Again, taking all this from the MAS Stability Review. This is the Private Property Rental Price Index tracking the quarter-on-quarter changes, okay? So this is not the fluctuation. So this is not the actual rental price fluctuation. If it's positive, it means rental rates are still on the upward trend. So of course, we've seen this sharp spike due to COVID, which really isn't healthy. Thankfully, it has sort of tapered off down into 0.8. So it's still on the positive increment part, and we haven't really seen it come to pre-COVID, right? I say despite the drop-off in rental, I don't see across the board, right, rates or rental rates going to pre-COVID prices or lower than pre-COVID prices, which is a good thing for landlords. But of course, there is still quite a fair bit of inventory on the market. It's really interesting to see how that's going to pan out moving forward into 2024. Now, thankfully, in 2024, the TOP supply isn't as high anymore. So this is probably the highest in terms of supply that we're going to see in the market, in my opinion. Now, probably a little bit more of a concern over here would be the vacancy rates. So now, vacancy rates have basically hit its 5-year high, if you ask me, and it exceeds the 10-year average on 6.8. Is this a cause for concern? It is a little bit, but again, right, how vacancy rates are calculated is very, very complicated. But again, if this tapers off with consistent demand coming in, then it's not too bad, right? But if it's the vacancy rates continue to be high like that, from 2014 peaking in 2017, it needs to be a cause for concern. But thankfully, this stabilization in rentals also comes with the stabilization of interest rates. Now, you're gonna be a bit concerned, or I would be concerned for the market if, say, rentals start to come down while interest rates continue to climb, because that's going to put pressure on landlords because their monthly mortgages start to come up, but then they're starting to see, or they're starting to struggle to find tenants, okay? But I don't see that happening yet. While of course landlords do complain that their mortgages are quite high, and especially for those that just collected their keys, okay, because they've been used to the progressive payment and now suddenly the call down is a little bit higher, and then because of also their loan is probably still pretty high at 75%. When they refinance it, the repayment, right, appears to be quite high, as opposed to those long-term landlords that have paid down quite a fair bit of their loan despite the increment in monthly mortgage, increment in interest rates. They are still relatively comfortable because after they've refinanced, the amount of loan is quite little left, so the repayments is quite okay. So now with this, am I overly concerned about this? Not too much, okay? While yes, there's a lot of rental units in the market, I don't see the rental units going empty for 6 months on end, 9 months on end, right? Probably during the COVID period, it was back-to-back kind of thing, right? Rental units being snapped up without viewings. Right now, there's probably back to pre-COVID periods whereby sometimes you go for like 1 month vacant, 1.5 months vacant before somebody take it up. Now, since we're talking about rentals, it's going to give me a good opportunity to talk about some of the new initiatives from the government that has been put into the rental market, and then we can start to see behind the scenes of why the government is doing these things, and let's see whether we can piece everything together. Okay, so the first of which is something that was just announced last week, right? I'm shooting this video on Christmas Day, right? So just last week, okay? The rental occupancy rate has been increased from 6 to 8, right? For larger HDBs as well as larger private properties. Okay, now the conclusion or the reason the government gave to this was to cater to more blue-collar workers, more students. I think it's a good initiative. Some of the questions I got from the landlords is this going to impact their rentals? It kind of depends on what you own. So now if you own a smaller HDB that you don't benefit from all this, you may be at a small risk that your rental may taper off, especially if you're renting out to groups of friends, right, who then, you know, take up 1 room each, because now, right, they can go and rent a slightly bigger 5-room or 4-room or bigger unit, right? So your 3-room and 2-room landlords, you should be a little bit concerned about this, right? So they rather get another 2 more people, especially for the units with 4 bedrooms or more, right? Then they have more people to share by the time they split, right? Accordingly, it's going to be cheaper for them. So the smaller HDBs, right, may be pressed. Now for condos, it's only beneficial for those of you who are, of course, have bigger condos, or those of you who are doing co-living in your condos. Now you can have more people. But for the smaller units, I don't think, right, some of you holding on to your 1-2 bedders, you may be a bit concerned about this, but honestly, I don't think so, because the tenant profile for your 1 or 2 bedders, they are those that can afford to pay, especially pay today's rates, right, are not the kind that would have gone to rent your, you know, co-living, your room rentals, or your HDBs, so to speak, right? So I think the impact for the smaller condo landlords would be very, very little for this, primarily to cater to blue-collar workers, especially workers coming in from Malaysia. They don't want to travel back, primarily for workers from Malaysia, right? I would think so, and also for students, okay? Now, the next interesting rule change to the market. Now, this is a very, very new segment, a very new type of property that has been introduced to the real estate market. It's been a while since we see a totally new kind of unit or new kind of property introduced to the real estate market, and these are the long stay service apartments. The traditional service apartments have a minimum of a 7 days stay, right? For now, the long stay service apartments have a 3 months minimum stay. And if you're going to read the whole thing, and actually if you read the article for the rental occupancy cap increase and this long stay service apartment one, the key takeaway I have is, right, better meet rental demand. But this long stay service apartment, the government was very clever in their wording from Singaporeans. But if you ask me, why they need to do all these changes and, you know, introduce a new kind of unit over here when vacancy numbers are high and rate of increase have actually slowed down. Why do they then still need to introduce all of this? I have a couple of hypothesis, right? Number one, I believe they are preparing to open up the floodgates a little bit. Maybe floodgates not a good reason. And I get a lot of hate for saying this. They maybe want to attract more talent into Singapore. And it's going to be hard for them to attract such talent into Singapore if our rental rates are so high, okay? If the demand is going to be, they expect the rental demand to be stable or to be as it is today, right? They wouldn't have, I don't think they would have done this considering the vacancy rates are high. But I think they do expect it to come up, which is why then they have to preempt that influx in demand, because they didn't preempt the influx of talent or the returning of Singaporeans to Singapore during the COVID period. I mean, to be fair to them, it would have been very, very hard for them to do so, right? So now they're doing this because I think they want to attract more talent into Singapore, bring more people in, of course, which is good news, especially for those of you who are concerned about this. Second thing, right, I think they did a good job, because one of the reasons, right, if you do read about real estate a lot, right, one of the annoying things are ABSD. Now, a lot of people find it very hard to plan their upgrades because they have to sell before they buy. If not, they have to incur ABSD, especially those with one name, right? For those married couple, you can do the remission. But again, now the ABSD is so high, it's also very hard for you to pay the ABSD first and claim back. So now all this, you notice, all this now is creating a lot of friction in upgrading. Okay, lowering transaction volumes, as we have seen. As you can see over here, right, it very clearly, one of the things he said, right, for those waiting to collect keys to their new homes, waiting for their renovations to be completed. So I think this is a very clever initiative for the government. So instead of, sort of lowering or removing ABSD, because that's gonna just erase all the hard work that they have done so far, right, introduce this measure or this option in between to say, you know what, right? Because right now, if you want to upgrade and you want to buy a new development, a new unit, be it a resale unit or new development, right? If you want to go out and rent, not much diff, but it's very hard for you to now go out and rent, because a lot of landlords don't want to take, even though the rule is 3 months minimum stay for private condos, landlords don't want to take those tenants, right? They much rather do 6 months to a year, right? Most of them want a year to 2 years one, right? They don't like the turnover. The agents also don't like too short lease, because then we have to do a lot of handover as well, right? So which makes it very hard for all these folks, right? Creating a lot of frictions for upgrading. So now they want to remove all these frictions, so introduce a new kind of service apartment, because the old kinds of service apartment with 7 days minimum stay is mostly for travelers and whatnot, right? Creating a lot of, they're quite expensive, right? So hopefully this creates a product to meet this kind of upgrading demand. People that want just a short interim stay while waiting for their new house to be completed. I think it's quite a clever move, and the deeper impact on the market, I believe it will reduce the friction of upgrading, helping a little bit with transaction volumes. Next up, onto one of the predictions that I didn't quite get so right, and that is my prediction that HDB prices will drop. HDB prices have defied what I thought would happen to them by continuously increasing in 2023, albeit at a slower pace than the increase over in 2021 and 2022. Of course, similar to the private side. But if we were to look at the price movements pre-COVID, right, it should have moved in a vastly different direction. And this would then give me a chance to sort of run you guys through the reason or the framework that I've utilized in my thinking that gave me that prediction, that gave me the idea to predict that prices will drop. This was the price movements between HDB and private pre-COVID, right? Starting all the way from 2013. So from there, previously they tended to track one another's movement quite similarly, but begin to fall in 2017, with private moving up quite aggressively while HDB prices continued that downtrend. And I boiled this down to two key reasons. The first one of which it's the divergence of financing methods between HDB prices and private property. For properties sold by HDB, BTO, resale, or brand new ECs, they are subjected to mortgage servicing ratio, which allows you to use only 30% of your monthly income to finance your mortgage. For private, however, it is governed by total debt servicing ratio, which today allows you to use up to 55% of your income to service debt. And what that means is essentially, if you are the same person with the same income looking to buy a HDB flat, you have half the budget for that as compared to private, assuming down payment isn't an issue solely from a loan perspective. And that brings me on to the second reason why I felt the prices started to fall in this manner. The other reason is PR eligibility for HDB resale flats. So before 2013, PR, the minute they get their PR status, they can go out there and purchase resale flats quickly or immediately. But today, or after 2013, they have to wait another 3 years before they're allowed to buy a HDB resale flat. Put yourself in the shoes of a PR that has been renting for most likely quite a number of years. Today, you finally get your PR, you have a decision to make. Number one, do you continue to rent for another 3 years before buying a resale HDB, or bite the bullet, take what would have otherwise been that 3 years of expense in a rental flat, put that down into the down payment for a private property, and for double the budget for your HDB. Of course, assuming down payment is not an issue. And that has gone to show a lot of the PRs then deciding, which is why a lot of the $1 million condos moved very well in that period of time, right? Regardless of its tenure. The shift of demand into the private market at that point in time. Okay, now what changed, right? Of course, this is also on the back of a lot higher MOP supply from 2017 onwards, which drove a lot of upgraded demand into the private market and whatnot. So what happened during COVID was a shake in supply for HDB. In terms of HDB supply into the market, I always tell people this joke is that, you know, you buy anything else in the world, most of the time, right, you buy a used product, new versus old product, right? New tends to be more expensive. For example, a car, right? You buy a new car, it's definitely more expensive than a second-hand car. But for HDB, you buy the new HDB is cheaper than you buy the resale HDB. It's not quite a fair fight, okay, if you look at it from that perspective, you as an owner of HDB versus a government. In that terms, right, a lot of the times, another reason why HDB prices took a dip during this period of time while private prices started to recover and moved up, really also is the fact that we were all brought up to learn or to understand or to accept that, you know, you buy BTO, it sure make money, right? Hit the 5-year mark, sell, make money and move up. But some people don't want to wait so long, so they bite the bullet and take some of the subsidies and purchase a HDB resale flat because they don't want to wait. But primarily the demand is towards BTO flats. But you know, during COVID, that wait time for the BTO got stretched from 3 years to 6 years, okay? And a lot of the buyers cooped up inside the house already for 2 months, very big tick already, right? So right out of circuit breaker, they say, screw this, I don't want to wait anymore. Let's bite the bullet and go into the resale market. So this shift, and also that the BTOs, they were supposed to be completed, were also delayed. So for those of them that already applied, the government actually gave them a waiver to say, you know, you can cancel and go and buy resale, we won't penalize you. So all this shift in demand, this surge in demand into the resale market resulted in this sharp spike in price right out after the circuit breaker ended. What brought me to think that, you know, I see that change in tide, that, you know, HDB prices may then revert back down to this trend, was because that supply shock was somewhat remedied by HDB. They kind of compensated for that supply shock by, number one, catching up on the delays in the construction, and number two, pumping out a lot more BTOs, right? Averaging, you know, 25,000 per year, right? 23,000 over here. Previously, they were averaging about 10, 15, 17,000, which is almost double that in terms of supply to the market, which was why, if you look at it purely, the things that impacted demand, they were still there, right? On the main issue that led to the shoot up in price was a supply side. So now the supply side resolved, so back to that status quo over there, right? By right, it should have brought back trend that we saw previously. But why didn't that happen? So now that is that thing that I want to talk about next, right? What changed? So first and foremost, the key thing that changed, it's the reclassification of HDBs, right? So now we have, ever since the National Day rally, prime and plus flats. While the prime flats were introduced earlier on, I believe it was 2020, the sheer impact on the market wasn't that large because of the numbers. But now they've sort of broadened the scope. We start to see quite a big number of them as a proportion of the BTO launch, right? That is the prime and plus flats, okay? And if you really look at the take-up rate for those flats, right, you can tell that the demand for 10-year MOP flats really isn't that high. Simply based on the fact that those launches had been 5-year MOP launches, right? They would have been way oversubscribed. But today, those flats, right, if you just go and apply it, I believe you'll get a chance to choose a unit, right? Also because, right, of the new rules in terms of the penalization if you don't pick your unit and whatnot lah. But the summary of that is that I noticed, right, a shift in demand into the areas, all these centralized areas, or these good areas, right, whereby the new supply coming in will be subjected to a 10-year MOP. A lot of people then, should they still want those locations, they were forced to pay and don't want to be locked into the 10-year MOP and don't want to wait. All come in and buy the resale flats in those areas, which is why you notice the number of $1 million HDBs in 2023 actually beat out the number of $1 million HDBs in 2022. And this is despite the fact that private downgraders were not able to purchase those HDBs, okay? Those rules, those 15 months wait up period, those rules are still in place, okay? One of the things that I expected the government to do is to take off that ruling once they managed to resolve this supply side issue but they didn't, right? And I guess that was the reason why, because they then now introduce all these prime flats and whatnot, right? So should they have removed that, right, the prices would have spiked even further. While this is in place, because what we see here is a overall resale price index. So, in terms of resale price index, they're always pushed up by, high quantum, high numbers. But it's not something that we see across the board, okay? So while, yes, the central location, especially those locations that will be subjected to prime and plus flats, right, those prices have continued to pick up. If you go to the more outskirts areas, that you see the supply being balanced, and basically the new supply, also 5-year MOP, the resale supply, those areas, especially if the areas have high amount of MOP units. And I noticed personally that the prices have sort of tapered off, and some even sort of starting to taper back down. But I guess the sheer number of high quantum HDBs and whatnot is sort of holding the prices stable, or if not pushing it up. And on this note, right, I stay over here, the supply not as high as expected. It's because previously I expected all this supply over here to be 5 years MOP, giving, driving a lot of demand away from the resale market. But turns out not all of these are the 5-year MOP, quite a number are the 10-year MOP ones that would not then create a direct competition with resale supply. And that is one of the reasons the supply wasn't as high as I expected it to be. A lot of people then will still pick resale properties, especially in those prime and plus areas, okay? Next up, this is a holdback of upgrader demand. And I want to bring our attention to this table courtesy of the Business Times. So what this table does is to track the purchase of new private residential units by residential address, okay? So, and we can see here is the HDB addresses, private addresses, and of course those people that didn't want to declare. One of the things you notice is this trend over here in 2019, a high number of HDB addresses, meaning HDB upgraders lah. This kind of corresponds nicely to high number of MOP units, right? This chart, MOP units high number in 2019, okay? But after that, notice that that number then started to come back off, even though resale application numbers were quite consistent, if not actually coming up. What that means, and what my takeaway from that is that upgraders are holding back on their upgrading, okay? And the reason for that, I point out to two reasons, right? First reason I state over here, the low supply in the private market, something that I've talked about a lot in this channel and something that we'll talk about later on in this video as well, primarily because of ABSD and because of interest rates and whatnot. And secondly is because a lot of the upgraders are also under the impression that prices, okay, so this is a more updated table as compared to this one. Okay, so this one I track private property price index versus HDB resale price index. So as you can see, right, just now we saw only up to here lah, where it started to fall. Right, so post-COVID, they have again started to track very similarly. So a lot of the upgraders, especially those that hit their MOP recently, they're just looking at this part which is the same. So for them, especially with stress test interest rates being high, private side nothing much to buy, they may be thinking that, you know what, then I might as well just wait lah, right? Number one, maybe wait for prices to drop or whatnot, or they don't feel too much of a rush to make that upgrade, which is what we see over here, hence bringing down the percentage of upgrader numbers over here. Okay, but should prices then start to appear like that again and start to fall again, right, I feel this is what I described that may cause a sort of reverse FOMO reaction, whereby they are then, you know, pushed to, you know, if I don't upgrade now, maybe I can't upgrade anymore, with prices starting to move in the opposite direction. So should prices continue to track in this direction, I believe HDB prices will continue to somewhat be stable. Next up, I want to share a little bit more data into the HDB market. So this chart charts the resale volume for HDBs in terms of resale applications, that's the blue line, MOP numbers, the orange line, and the resale price index. This one, in the end, it wasn't so clear, so I wanted to show in another method, another table. Again, this is similarly correlating resale applications with MOP units, okay? In 2013, 2014, the MOP numbers really were very little lah. Yeah, very little, okay? But at that point in time, you see the resale application actually quite high. So when we went down from, you see the numbers going from 1,000 MOP to 30,000 MOP. This is a good 30,000 extra units that hit the MOP, right? But the resale application numbers only go up by about 5,000 over here, okay? It did see a spike over in 2021 post-COVID lah, right? Of about 7,000 extra, but this is on the back of a consistent increase of, you know, 31,000, 17,000, 21,000. And so we saw another bumper crop of MOP numbers in 2022. But we have not yet seen a sharp increase in resale application to show this significant increase in MOP numbers. Again, to back up my sense that a lot of the upgraders are holding back on their upgrade. Okay, two reasons again, right? Interest rates, and also because they feel prices are moving in the same direction. If prices continue like that, fine. But if prices start to fall, I think things will then start to change. Again, why I feel things will start to change should prices start to fall is because of affordability. On average, HDB 5-room and executive owner, alright, average household income, median household income is 13,000. And if you then calculate that in terms of TDS, assuming they take a 75% loan, 4% stress test interest rates, they can afford private up to 2.12 million, okay? But they have not upgraded yet lah, because right now they feel their asset, the prices are moving in the same direction as private, no rush to upgrade. But that is despite the fact that the percentage of the household population it's living in HDB flats is on the somewhat downward trend, 82% down to 77%. So now you might be asking, hey Alvin, these numbers like don't tally. First, you see upgraded numbers starting to come down. Seems like it's on the downtrend, right? But the percentage of population living in HDB also down. So what's happening, right? So if you think deeper, what are the pockets of the demand into the residential market that's not HDB upgraders? We have first-timers, people that didn't stay in HDB before, first-timers. We have then, like what I said earlier, the PRs, right? New citizens, right? Of course, foreigners, they take up the very small number, right? PRs, okay? So what that goes to show is that the new entrants into the market, what this table shows, the new entrants into the market are preferring private, and that is with, you know, somewhat subdued upgrader demand. So now if the upgrader demand then spikes up this number, then will continue. I feel will continue the downward trend, right? The conclusion for this is overall the fact is that people can afford to upgrade if they want to, and the data also shows that more and more people actually are starting to prefer private properties. It's more so a question on when and what's the sort of trigger to all of this, okay? But my conclusion over here is that instead of accepting or instead of predicting that prices will then come down, This one later on in the video, I'll give you my prediction on where I feel HB prices will go. And moving on to prediction number 6, the high take-up rate in launches. And for this, I believe most of you would have agreed that the take-up rate of the launches in 2023 was very good lah. But I'm going to be quite critical with myself and give me this phase lah, right? What this phase means is not right but also not too wrong, basically 50-50. And let me explain why. I classify project or launch as a high take-up rate, well sold, right? If it sell above 50% at launch lah. I sort of have classified all the launches in 2023, slightly larger launches, right, into about 16 of them. And out there's 16 of them, just nice right smack down the middle. 8 sold above 50%, 8 sold below 50%, which is why, I gave myself this score of this phase. And so, right, let's take a look at some of the best performing launches over in 2023. We have Jden that sold 88% at launch. Yeah, I have an average PSF of 2451 PSF, and this is in Jurong, mind you guys. We're real benchmark prices, and I think this price, the interesting thing here is this, right? The Jurong East area really is the benchmark price setter, always been the benchmark price setter for PSFs in the market. Because the last one, right, J Gateway set the benchmark PSF then after that, everyone else started to follow through, right? So now Jden is the new Jurong East one, so setting 2451. And believe it or not, this is where the market is going to head towards lah, right, moving forward, okay? For the OCR, of course, not going to be immediate, right, but sooner rather than later, right? Right now, you can look at J Gateway that time launched 1,700 PSF, albeit a good 10 to 13 years ago. Second best performing one, Blossoms by the Park, 73% sold 2423 PSF. This is over at the One North area. Okay, then we have the Reserve Residences, 71% sold, very well received. That's a matter of fact, right? Jden, Reserve Residences, I didn't expect them to sell to this level, this popularity, especially because of the kind of price points. But now, in hindsight, if you look at Reserve Residences average PSF and compare that to Jden average PSF, the first day buyers of Reserve Residences have nothing to worry about already. And one of the takeaways from Reserve Residences, I am taking this opportunity to share, is that I was surprised at how many of those buyers really came, because my team closed quite a fair number of units over at Reserve Residences. Quite surprised at how many of those people, the former D10, those people that stay D10, right, wanted to buy these Reserve Residences, primarily because I did share this a little bit in the video, my Reserve Residences video. So out of all this, I did reviews of all this. I'm going to put all the links inside. Okay, not all of them, but quite a fair number of them. I did a review of those. I can put that down into the description below or somewhere in this video. I did say inside that I believe there was going to be sort of an emotional attachment to the area, because a lot of good schools, your MGS and the good schools people, they kind of grew up in that area, and the Reserve Residence really is going to be the attention grabber in that area, the main marker in that area, and that's going to drive demand, and the amount, the sell-through rate kind of proved that way, right? But still better than what I expected, because the Upper Bukit Timah, the Beauty World area, wouldn't be the first choice if you previously without Reserve Residences. If you ask the folks that stay in the D10 one, right? But suddenly Reserve come out and then they're all okay with the area, I guess, because of the amenities and the whole build of the Reserve Residence Far East and whatnot, okay? Then we have Sinaka over at Tanah Merah, MRT selling 60% at 2,000 PSF in Tanah Merah. Again, better than I expected it to be honest. Okay, Wharton House also 57% at 3,200. This is perhaps somewhere within expectations. I did expect the 3 compact, the smaller units over there, to sell through. Again, I've done a review on this as well. You could check that out. This again, right, goes to show the CCR really is very diverse in terms of the supply into the market, and also in terms of the demand into the CCR market. They are very, very discerning. Okay, and of course, I do expect Wharton to continue to outperform moving forward. Really, the area anchored down by very strong organic demand, albeit, not too close to the MRT, public amenities, but who cares, right? Those people that can afford those. And anchored down by 2 very popular primary schools. And then we have Grand Dunman, 55% sold. So this is over 1,000 units, so 55% sold. So on itself, it's almost bigger than quite a fair number of the rest of the other developments. On its own, 55% sold already. Again, very impressive, very sought after development, very anticipated development, which is why this, again, not surprising for Grand Dunman. We have Tembusu Grand also in District 15, 53% sold. So very popular. This one slightly earlier in the year. It was the first of that 3 projects to launch in District 15. These 3 brothers, right, so to speak, 53%. So, and then we have Lentor Hills Residences also 50% sold. Again, this Lentor Hills being 50% sold, a bit better than I expected it to be, especially considering the fact that most people going to the Lentor area are aware of the potential oversupply. They are willing to accept it. I believe also this one because it's anchored down by St. Nicholas Girls and also walking distance to the MRT, and also the price point is quite a fair bit more acceptable than Lentor Modern, and a lot of the buyers have seen the Lentor Modern performance that gave them some confidence to enter in despite the fact that it's above PSF, right? And then we look at some of the reasons why these developments outperform and why I feel, later on I give them my predictions for the next year. The reasons for the outperformance, right? Number one, the resale undersupply. Again, right, I'm going to dive into this a little bit more in detail later on in the video, but basically in the resale market, if you want to find some good areas, cannot find. Give you an example. You want to find a Wharton Estate, similar units at that kind of price quantum, because Wharton Estate, you go surrounding, really no supply one in the area if you want a 3-bedder at that kind of price quantum. Okay, JDen, similarly, I've broken down the supply into that area, J Gateway or the older Ivory Heights and Westmere, that kind of thing, right? So for particular areas or like-for-like areas, there really isn't much options available to you. If not, then the options are very wide apart. My theory of the old versus new supply, which then makes a lot of people then choose to decide to buy a new development, right? And also personally for ourselves, right, the clients that have picked the slightly newer development or pick all these new developments, all of them are, they straight up decided that they want to buy a new development. Not all of them decided that, right? Quite a fair number, right, actually went around looking in the resale market, but they really cannot find anything of good value or of the characteristics that they like. Some developments, a lot of units, but anytime 2 to 3 units for sale, sometimes low floor, the facing they don't like, blah blah blah. Might as well go to a new development. You can pick the facing and all those. So resale undersupply, not enough choices in the resale market. And then when the resale market have choices, a lot of the sellers are asking very high prices, some even with COV. Okay, but if you go into the new development, there's no COV involved, the valuations will all match up. Lastly, like our minister said, a lot of Singaporeans today are more open to renting already, right? So I do see quite a fair number of them. Some of them are already on rentals, right? They didn't decide to just continue renting to purchase the new developments, or they're really just not that closed off to, just sell, go out to rent and buy a new development as they get something brand new. They get to choose the unit, the facing, and then they don't have to buy at above market prices. Of course, then we also have some of the developments that underperform, and when I classify underperform is under 50% now, which is why Botany, Sway 48% and fall under this. Over at Dairy Farm, we have Terra Hill at Pasir Panjang, 38% sold. This one is freehold. Surprisingly, one of the things you notice over here, only Wharton House over here is freehold. But over here, under this 50, those underperforming, right, that's freehold, and Terra Hill, that is freehold. Right? Quite interesting thing to note, right? Freehold really nowadays are getting less and less popular. Despite the fact that their PSF, in the end, their quantums are not that far away from their 99-year counterparts. Okay, we have the Garden Residences, the Lake Garden Residences, 31% over at MRT 2110 PSF, only 31% sold. We have Pine Tree Hill, 29% sold. Pine Tree Hill at the Mount Sinai area. Hillock Green, 28% sold. This one is at the Lentor area. Continuum, one of the 3D15 brothers. Surprisingly, considering the other 2 brothers are 53 and 55% sold, this one being the only freehold one in the area, only 27% sold. Somewhat surprising to me, but of course, if you want to see whether it's good value or not, you can watch my reviews. Actually, very simple. If I honestly don't think the development is good, usually I don't do review for that development. Those that I do, usually usually I feel, quite okay, but of course I will put in my caveats and whatnot lah. So if you want to see this list and see which ones I feel got good value, you just need to go and see the playlist and to see which ones I did review, and you get the answer. Okay, then we have the miss over near at the Chestnut area, 27%, and of course this one it goes to show CCR all made very differently. We have one CCR here, 57% sold, and we have one CCR here that's 2% sold, right? The former Maxwell house, quite sad in terms of their performance lah. Next up, on to prediction number 6, popularity in sub-sales. And this is perhaps one of the simpler ones to predict. First and foremost, because the amount of TOP supply in 2023 is going to be higher than that in 2022. And as of 2022, the sub-sales were already at a 10-year high. Over here, the percentage of transactions lah, and they broke down the colors accordingly based on, over here, we have new sale, sub-sale, and resale. And you can see the sub-sale bar basically being thicker than it was in 2022. Perhaps I guess it's a little more relevant for me to share with all of you some of the reasons why sub-sale is so popular. So first and foremost is because, and let's break it down into both sellers and buyers, okay? So for sellers, right, number one is they're already sitting on profits. So it's a lot of the discussion on, make more or make less, yeah? So for some of them, they're just looking to cash out and roll that into another purchase, right? We have a couple of clients that have done so. Another reason why is because they have gotten sort of like, rinse and repeat, sort of addicted in a way to just buying this and flipping it out for a close profit, for a quick profit, and especially because the monthly repayment is also lesser. So imagine at that point in time the interest rates were low, they already enjoyed it so much. And for today, that differential as an investor, should you buy resale or new development with interest rates being elevated, all the more shifts that narrative a little more, shifts that calculation a little more to a new development as well. So they are just looking to, rinse and repeat this process, this investment process. But another reason is some of them are already possibly renting. We have some clients like that as well. They were already renting, they collected their keys to this development, and some of them, they don't feel that the size is sufficient. So some of them are also thinking, hey, what if I cash out and then I roll that profit into a slightly larger development? The friction over there, the inertia over there to roll it to another development is lesser than that, as opposed to a resale owner that already has been living in a house for the last 10, 15, 20 years with a lot more emotional attachment to it. The friction to then sell it, go out to rent and buy a new development is a lot, or buy anything else for that matter, is a lot stronger as opposed to one that's already renting, right? So secondly, there's less emotional attachment to them. It's just another development or an investment, or it hasn't even turned into a home yet. As long as you hit the price, they're happy to let it go. And a lot of them, they don't have as high expectation on the sell price as opposed to other resale units. Another reason for that is also because they haven't incurred that much interest yet, right? Or let's say a resale owner, if they stay there for 10 years, they've accrued a lot more interest, right? As opposed to one that has, did progressive payment and just collected their keys. This reason is also quite interesting. A lot of them don't want to rent out, especially now with the new property tax, potential income tax, interest rates and whatever. A lot of them don't want to rent out, so they just say like, you know what, let's just cash out the profits and roll it to the next one, or just cash out the profits altogether. Lastly, the sellers are more realistic because they understand the supply situation, that they have to deal with a lot of competitors, a lot of neighbors, right? They're more realistic in terms of their asking prices, right? They just have to go to Property Guru, any new development, similar unit, at least 20 for sale. If you got smaller ones, sometimes like 100 to 200 for sale. They know they can't price it, way out of market, as opposed to a resale owner that you go into Property Guru, you see maybe you're the only one for sale, or there's only one or two other units for sale, you then feel that you can ask for a slightly higher price. So all in all, that concludes like basically fairer asking price on the part of the sellers. So on the buyer's perspective, they tend to like all these sub-sale units also because number one, they don't have to wait anymore, or they don't have to wait as opposed to a slightly newer development, and they get a brand new unit. Okay, they don't have to spend that much on renovations, especially now with renovation costs being expensive, especially higher. Should they buy a brand new TOP one, albeit slightly higher than the resale one, but most of the times the condition obviously is going to be brand new, right? Sometimes the resale one, the asking prices is high lah, need extension lah, cannot even choose your facing lah, all those kind of things, right? Just makes all these sub-sale units look a lot more attractive, right? There's more options available, more units available as opposed to resale, and of course, because of the above reasons I mentioned, more realistic asking prices because of the supply situation and because of the dynamics that we see over here from the sellers. On to prediction number 7, the continued undersupply in the private residential market. Now, some of you may be saying, hey, Hsien, I read the news, next year going to have 40 new developments to be launched, and the papers always publishing, GLS supply 50%, 100% more than what they were in 2022. Are you sure that the private residential market is going to continue to be under supply situation, right? Based on what I read, it's going to be oversupplied. And so if you take a look at this chart, if you take a look just like that, this is what the newspapers would show. Or this is what I would show if I want to capture attention and to create, some fear. Because in terms of headlines, fears always grab headlines, okay? So if you look just like that, okay? And on the year-on-year difference, it does look like it's a sharp upwards, okay, in terms of GLS supply. But it's always important for us to look holistically and look at the big picture and look on a more longer term average. So, which is why I put again these two charts out thanks to the MAS Financial Stability Review. First chart, unsold inventory, developer unsold inventory. As you can see over here, despite that increase in GLS supply, the unsold inventory still stands quite a fair bit lower than the 10-year average, right? Of course, some of this supply has not yet been translated into this chart, but even if you see this increase in about 2,000, even to 3,000, right, here we are at about 15,000, it's still going to be quite a fair distance away from the 10-year average. Yeah, we are quite similar to where we were over here in the 2017 period, despite the fact. So what happened over here, for those of you who don't remember, this was where the unsold inventory came down very low, and that sort of triggered the en bloc rush. Do I expect that to happen again? The answer is no. So the next chart is to illustrate the en bloc numbers, again always moving in cycles, but this time around you see quite a similar cycle, so to speak, but on a much lower amplitude, right? And I don't expect the numbers to come up significantly, and for the reasons like GFA harmonization, interest rates high, construction costs. And this time around, okay, so the last time around, if you notice, this during about 2017, unsold inventory came down too low. The government were a bit slow to react to increase the GLS supply, which was why the developers all rushed into the market. This time around, the government wanted to prevent that situation from happening again, and this time they sort of front-run the developers. So once GLS front-runs en bloc very hard to happen because developers much rather pick GLS. They save the time for knocking the development down because all those times are factored into all the ABSD and those sort of things, okay? So conclusion, over here you can see over here so supply in the private residential market, either new or resale. So on the new part, I don't expect an oversupply situation happening. As a matter of fact, it's going to be quite low if you look at it from the 10-year average perspective, okay? In terms of resale, there really isn't a good way to analyze supply, I guess, which is why the best thing I could do was to borrow this chart, right? And this index by the single biggest portal in Singapore for people looking to sell their properties, right? Property Guru. So over here, they have the supply index that track all the property sale listings, yeah? Pretty close, right? Best thing we can have in terms of supply. So you can see from 2018 until now, the numbers actually did dip down in last year, but it have picked up a little bit to this year, but it's still again on the baseline, below the baseline of 100 lah. Over the longer term, quite a distance away from their so-called demand index. So all in all, I do not expect resale supply to pick up significantly. The main reason, again, with which is that the replacement cost of units still tend to be quite high. So if the resale supply were to come up, I feel in this time around in the market. It will not become an oversupply situation, but more of the resale supply comes up because the prices and the interest rates have normalized, and then it becomes a lot more palatable for people to move, and that will actually drive up, right, transaction volumes, and that transaction volumes then will drive up prices. So again, you have to look at demand and supply hand in hand lah, right? So there's no way the resale market will go into an oversupply situation, especially with ABSD rules involved. Those with 3 properties and above, they just won't sell their property because they can't replace them. And on to our last prediction. I kind of predicted that the market will pick up in the second half of 2023, basically based on 2 reasons lah. First, the continued undersupply, and secondly, because I did expect the demand to pick up with a push in HDB upgraders. While technically the data suggests that the market did pick up, right, off the back of 2022, there was still a continued rise in private property prices based on the property price index. But if we were to be critical with ourselves, right, you don't sense the kind of euphoria, the kind of FOMO that we sensed in 2020, 2021, right? The kind of sellers, intense sellers market, bidding wars, you know, units being put up, sold in a jiffy kind of thing, right? Or similar to what we saw in 2018, early part of 2018, leading up to the cooling measures in 2018. So while data wise shows that the market is still going up or picking up, the actual market sensing probably not so much. And so let's dive down into the reasons why we don't yet feel the euphoria in the market. And so I want to touch on one of the, perhaps also some of the reasons why I thought the market would have picked up in the second half of 2023, right? On a euphoria sentiment basis other than the data perspective. So I bring us back because I really feel where we are in the market today in terms of supply is very similar to, perhaps this is a better chart, very similar to the 2017 period. Again, right, bringing back this table again, right, the total number of unsold developer inventory. Okay, so notice how we are very close, very similar to the 2017 period. And when that happened, right, it led to a surge in demand for land by the developers, and they bought it up, and that brought huge spike in terms of their unsold inventory. But that also correspondingly, so this is the same table if you look at it in terms of the unsold inventory, right, that kind of led to a sort of delayed spike. You see this turn over here where they started to buy up more land, and because they buy up more land, the new supply is at the new benchmark prices, and when they launch, then it lead to that spike over here. But of course, this was on the tail end of a consistent drop in the prices, so maybe that was why, you know, we saw this huge uptick. The difference here is that today the property price index is already on the upward trend. That's the difference over there, which is why data suggests that it still continue to go up, but sentiments wise not so much, right? But you know, without going into too technical on the data kind of things, right, notice how the developers were not as bullish as they used to be, right? They didn't come in, right? So all this I explained a little bit earlier on in terms of the construction costs and whatnot lah. So in the absence of which there is not that much supply in the market, even for the new launch perspective, and when they were still bought up pretty well. So on that note, on that small sector in the market, there is still some euphoria, so to speak, but not so much in the resale market. And this is just one of the reasons why we don't feel the euphoria as we did used to see at that point in time. Sharing another data point, right? This is a tracker of MOP numbers to the private property price index. So notice again, right, in 2019, right, there was a huge spike in HDB MOPs, and that sort of led to this sharp increase over here in the private property price index. Okay, now we see another bumper year of MOPs in 2022. If you follow this trend on pump, high number MOP, spike in prices, 2022 bumper crop of MOPs, sort of, you know, if you draw the similar correlation. So this was why I felt, or I took this indicator as like, you know, we're going to see a bumper crop of people coming into the private market on the back of low supply, would have led to a sharp spike in the market, you know. The conclusion is, why didn't that happen, right? As we have seen in the data previously, you know. This may be one of the reasons, right? Because previously when I made that assumption or made that prediction, I didn't really see the breakdown in terms of the trending of resale applications as a function, right? Correlated to MOP numbers. So you see over here, this was the table that I shared earlier, right? MOP number is high in 2019, but actually you see the pickup in the applications was somewhat delayed. Now, the spike over here, but you see the application number didn't spike so much immediately in 2019, but came slightly later on in 2021. Of course, if you strip COVID aside, but you do notice the trending is upwards, right? So conclusion is there's sort of a delayed reaction to the bumper crop of MOP numbers. These are the kind of some of the summary of what has caused the delay in the pickup of the market. I would say the main thing over here is that interest rates have remained high. As we said, I repeat again, interest rates are the grease in the gears of the real estate market. Basically the grease in the gears of the entire financial market, and of course, of which the real estate market is a small subset. And so then that has led to, you know, number one, with developers not buying up the land at overly aggressive rates, right? Delay in benchmark prices being set. I mean, some of the benchmark prices have been set in the new launch market, but the resale market, because volumes are low, as I indicated over here, has not yet seen the speed to reach the new benchmark prices that has led to this sharp increase over here in terms of the property price index, okay? Reasons for the low volume I have shared with us earlier on in the video, so I won't really repeat that. Again, right, there's the HDB price resilience, right, bringing us back to, again, this table over here, right, with prices tracking very similar to one another. HDB owners really aren't that incentivized, or, you know, aren't in a rush, as much of a rush as they were in 2018, 2019 to make that move, as opposed to during that period of time where HDB prices and private prices were moving in opposite directions, okay? If and when that repeats itself, right, so moving forward, if private continue to go and HDB sort of tapers off or come down, that is where I predict would be sort of the trigger point. So first trigger point, interest rates, right? Second trigger point, HDB prices. So of which HDB prices have proved to be surprisingly resilient, of the reasons I've explained earlier, right? That has pushed back, delayed the upgrader demand push, right? Again, you could also exchange the word delayed with pent up. So again, I still stand by what I said in 2022 that surge can be quite strong because of a lot of this pent up demand, so to speak, okay? And I want to bring our attention to this, the unseen effects of interest rates, okay? What most of the market deems to be the reaction of interest rates to property prices is interest rate go up, people can't service their mortgage, you know, then they're forced to sell the property, or they are in a rush to sell the property. But that is really the theory, a very outdated theory already. As we have seen, Singapore, the average LTV is below 50%, 40 something percent, so nobody really is going to rush to sell their properties because interest rates have picked up. But why, again, the interest rates have impacted the volumes in the market? It's the fact that the stress test that the banks use to evaluate how much loan you can take has been bumped up from previously in 2020, 2021 at 3% as MAS has stipulated, 3.5%, today to 4.7%, right? MAS stipulates 4%, but the banks, kiasu, they have utilized 4.7%. Just to put things into perspective on how many percent or how much of a difference that makes to someone's budget. If you have a combined household income of 10,000, the difference in budget, it's 130,000. If your combined household income is 17,000, it's 200,000. 22,000 is 217,000. But if you break it down, it's in the ballpark of 9% difference in your budget. So now if you look at this, and what's going to happen, right, once interest rates normalize, or, you know, if they do come down, I don't expect the banks to keep their stress test or unnecessarily penalize themselves in terms of the stress test interest rates to keep it at 4.7%. All it takes is for one bank to adjust their stress test rates down, the rest of them will follow, and they will then all adjust back down to the MAS stipulated 4%. So with that, people all get a bump bump in their budget. And so as I explained, a lot of the reasons for the low volume is because sellers asking prices are high because their replacement cost is high, right? And buyers can't seem to reach that asking price also because of the loan, the TDSR loan that they can take. Probably their equities. There are a lot of the clients I work with, they do have the equity probably stuck in their house lah, but they also have equity. In terms of equity, sufficient, right? But the loan is the one actually that's holding them back. A bit of a difference between what's happening in the market today as opposed to the previous years, right? It's the loan issue. So now, if they get that bump up in the amount of loan, that brings that gap a bit lower, and definitely some of them, the needs-based ones, will come in and breach that gap. And whenever one seller sells a property, he becomes a buyer, and then that then leads to that chain reaction, then that creates that upward push in the market in terms of volume like we used to see. So that sums up my review of my 2023 predictions. In the end, we got 5 out of the 8 correct. I personally thought that that's pretty decent. Not sure about you. Let us know in the comments below, and of course continue watching in the video as we give you our predictions for 2024. And so here's the top 3 things that happened in 2023 that really surprised me. Number 1 is the new launch performance. While I kind of predicted that new launches will continue to do well in 2023, some of the standout performances really surprised me. If I bring us back to one of the earlier slides, Jayden hitting 2451 PSF in the OCR at 88%, so that's honestly something that way surpassed what I expected it to do. In terms of PSF, maybe not so much, right? Because I've said it quite a while ago that I predict OCR PSS will definitely cross 2000 because of all the Lentor bids earlier on, but mid 2000 PSFs kind of knew that it might happen, but probably not so fast. I thought it would have been achieved for the higher floor units over at Jayden, and 88% sold. So this is one of the standout performers that shocked me, surprised me. Another one is actually Sinaka Residences, right? Crossing 2000 PSF in Tanah Merah. I mean, the way they bought the land cost was already there lah, but I didn't expect it to sell 60% of Sinaka Residences, so that was also some of a surprise to me. The performance of Grand Diamond, while I knew it was very, very sought after, very, very anticipated launch due to its location and the number of units, it crossing 55% sold. It's quite surprising. It didn't shock me, but you know, it's probably a bit more than I expected it to be considering the PSF that it was launched at. And also because there's a lot of alternatives, right? There's 3 launches over there: Grand Diamond, Tembusu, and Continuum. So on this part, right, maybe you wrap up these 3 to analyze it together. So this really goes to show, right, that freehold properties really aren't that popular anymore. But then for the people that like to think contrarian, think on the flip side, then you know, is it time to consider some of those, especially if you notice that their quantums are not too far away from one another, right? So while I say surprise in terms of the new launch performance, surprise in terms of how some of the launches have performed, but I'm also surprised at how much some of them underperformed. Okay, such as Pine Tree, which is one of my personal favorites for those of you who know, coming in at 29%, because fundamentally it's as strong, if not stronger, than some of those that's better performing. And also Continuum, right? Of course, if you see in terms of the PSF, like that is 200 PSF more than, let's say, Grand Diamond or Tembusu Grand. But if you really look into the nitty-gritty, the details of Continuum, right, the developers were actually quite smart to build some of the units a little bit smaller, so to give you a quantum that's actually very comparable to the other 2. So on that perspective, I was also quite surprised why a lot of them actually chose to take up some of the 99-year units as opposed to the similar quantum freehold ones lah. But of course, given time, I do expect all of this to continue to sell through pretty well. The second point that surprised me is the HDB price resilience. I mean, coming back to the data to show the bumper crop of MOP units in 2022, very naturally you expected prices to sort of kind of taper off, but continue on that uptrend, primarily, in my opinion, down to the new reclassification of HDBs, like I explained again earlier. So with the new prime and plus 10-year MOP and very restrictive resale conditions, it kind of have forced the demand, right? So had there not been a reclassification, why I feel prices would have tapered off, because a lot of the demand would have then gone to all these BTOs in all these central areas. But right now, people are kind of holding back, thinking to themselves, do I really want to be locking myself up into 10 years? So what do? Right, if they don't want to pick those, they still want to buy in those areas, then they go into the resale market. So the demand has now gone into some of these centralized resale markets, and if you know, all those are your $1 million HDBs or very highly priced HDBs, and what that has done is to then push or keep the data moving upwards, the HDB price resilience. But this price resilience is not something you see across the board. For those of you or in the slightly further out regions with a lot of MOP units, then you do notice some of those units taking a little longer to sell, and also some of the prices not maintaining so well. So while the overall price index is going upwards, in certain areas I'm already starting to notice prices tapering off or coming down. And of course, lastly would be the lower land bids. A lot of us were sort of programmed into assuming that land bids will continue to come up. But this year, what has surprised me is the land bids coming down. Number one, the lower number of land bids, right? Let's give you some perspective, okay? So if over in 2017, right, we have Daintree residences, 24 bids done, right? This was the highest number in that period. The highest number in this period, ECs aside, right, turned out to be Clementi Avenue 1 with just 6 bids. Now, why is this happening? With all the new restrictive rules post 2018, now with developer ABSD continuously climbing, increased construction costs and whatnot, notice a lot of developers now, it used to be each and every one of them go out on their own and try to buy the land on their own, but right now you see a lot more joint ventures, easily 2 if not 3, and they tend to like to bring a builder on board. We have this as perhaps a bit more like for like, right? Same thing, Toa Payoh, and these two plots are quite close to one another. We have Jam Residences, 14 developers bid for that land over in 2015, but this year, despite it being a very low supply area, Toa Payoh and consistently very good sell-through rate, only 3 developers bid for that plot. So what surprised me is the low number of bidders for the plots, but also one thing that really surprised me, it's the lower land cost, lower land bids. As you can see over here, right, Jalan Tembusu in 2022, that turned out to be Tembusu Grand, okay? See, the land bid was 1302 PSF PPR. The plot right beside was sold to Simlian in 2023 for 1069 PSF PPI, and that's a 17.9%, 18% difference in land cost, lower land cost. Another one, Pine Grove, right, that turned out to be Pine Tree Hill, highest land bid 1318 PSF PPR. The plot right beside Parcel B, won by MCL in 2023, right, very recently, 1223, so a 7.2% drop in land cost. Now, how does this affect our analysis or the conviction that we have in the real estate market? Because the way we've been brought up to think is that land costs will continue to go up, hence property prices will continue to go up. Land cost is coming down. Does that necessarily mean prices are going to come down? That brings me to the next point, which is the top 3 things or the top 3 must-knows from 2023. So what are these 3 things? Why do I say must know? Right? It's because these 3 things fundamentally impact the real estate market, change the entire makeup, or they change out the fundamental understanding, the fundamentals with regards to the real estate market. And of course, the first thing, which is the main reason why land cost is coming down, it's GFA harmonization. I won't go into great detail on what GFA harmonization is, but the long story short, right, is that today developers basically cannot sell you the aircon ledge, or they don't have the aircon ledge for free anymore. They don't have the balcony for free anymore. They used to have it for free, which is why they build it big and charge it to you. But today, all of that is now considered under strata area. So they then have to pay for all those land. okay, for all those areas, right? GFA harmonization. And how does that impact the developers? It shrinks their profit margins, right? So with that, which is one of the reasons why then they have to factor that in together and bid lower for the land. And so of course all this add together with the fact that interest rates have also gone up. So in GFA harmonization, it impacts developer profit margins by 4 to 5% before the rules and after the rules set in. And another thing that people don't really see, it's the increase in construction costs. So I took this table from the Business Times. Okay, so as you can see, right, in 2022, just a year difference alone, the construction costs can go up by 13%. 13%. And as you can see over here in the survey that NUS does with developers, you notice most of them are concerned with rising construction costs. Of course, they also have concerns with the global environment and whatnot, right? So knowing all of this is probably the reasons for the lower number of bidders for the plot of lands in the GLS. The reason for the lower land cost, primarily you can see over here, tightening of liquidity interest rates, right, and rising construction costs. So if you do tally all of this together, you notice that in 2022, if they bid for the land, and 2023, if they bid for the land on the cost basis, profit margin basis, they have to factor for close to an 18% differential, and that's the main reason why it's important for you. You must know what GFA harmonization is so that you are not overly concerned with the drop in land prices. Next up, it's the long stay service apartments, okay? So this is a new segment in the market that the government is kind of introducing, right? I explained it earlier in the video. Singaporeans that look to have to sell their property, go out to rent for a short while waiting for their new property or before they move into their new properties, sort of to bridge the gap in demand for such shorter term stay units, right? 3 to 6 months. So while it says long stay service apartments, right, it's a minimum stay period of 3 months as opposed to the traditional service apartment that has a 7-day minimum stay. How does this, why is it must know for you? Because this is then going to impact the demand for rentals moving forward, right? How does it actually going to impact? Time will tell, because number one, this is not a huge surge in the supply into the market, just 500 units to test bid the thing. But definitely, if this turns out to be one of the options available, right, like I said also, it will make things a lot easier for upgraders. They don't have to time so tightly, because then now they can go out and rent all these long stay service apartments. And what that does is it reduces the friction. Not so good for rentals, but I feel good for transactions, good for selling and buying, reducing frictions, more affordable for people to first sell first, rent, and then buy, versus right now today they have to time it very, very close to one another. So like some of the clients that I deal with, they don't want to go through the hassle of moving twice, because if they were to move out, if they go to short-term stay service apartment, those minimum 7-day stay one, right, very, very expensive if they have to stay 2 to 3 months, right? But if they want to go and rent, minimum stay for private, usually they ask for 6 months, yeah? 6 months to 1 year, right? Sometimes 6 months they don't even take. So this one really comes in to fit that demand. Then next up is the HDB reclassification. Also very, very important thing to know, because I think this fundamentally changes the real estate market, impacting demand for resale HDBs and demand for new HDBs. Traditionally, before this was done, right, pretty much straight up, if you want to make money, make that jump after 5 years, you go for BTO or 5-year MOP. If you are more urgent, you don't want to wait, then you go and buy resale HDB. Today, I would say it's split up into sort of 3 segments lah, right? So because you have resale, and then you have BTO, and BTO you have the 5-year one and the 10-year MOP one, right? So then now you have this kind of choices. And then if you don't want the 10-year MOP, but you still want the location of, then you flow back to the resale, you flow back into the resale market lah. So now demand becomes split into 3 different types. Now, in the long term, how does that impact HDB resale prices? In my opinion, right, that will cause an upward push. We may see a higher number of $1 million HDBs in the central location, because all those HDBs, right, are only subjected to the 5-year MOP rule. You serve finish your MOP, you can keep those properties and rent out, something you can't do for the prime and plus flats, right? So all this, and then for those of you who follow me or those of you who watch earlier on in the video, right, HDB demand, HDB prices, if they were to move in tandem, they will have impact on private real estate prices as well. Now, how does this all wrapped up together? Only time will tell, but it's important that you understand some of these new fundamental changes in the market that was introduced in 2023. And before we head into what I expect would happen in 2024, as usual, I like to build off the fundamentals of the Singapore real estate market a little bit more, and as my favorite, I like to utilize the MAS Financial Stability Review just because of the sheer amount of data that they provide that is undisputable. So now let's take a look, and I'm going to zoom in more into the real estate part to things, okay? Housing loan growth has moderated amid higher interest rates, and this one as expected because volumes have come down, which also means housing loan will also come down now, okay? As we can see over here, right, similarly as with housing loans coming down, volumes coming down, right, the rate of increase of housing loans will taper off. Over here, quite a good chart is something I refer to quite a lot. It's the loan to value. So this is the average loan to value for general Singapore household. So while MS allows a maximum of 75%, if we average across the board, it's just 41%, which kind of explains why the market didn't really tank despite the sharp increase in interest rates, okay? And also kind of explains the very little small correlation, or as a matter of fact, little to no correlation between property prices and interest rates in today's market already. Strong household balance sheet and adequate liquidity cushion the impact of higher interest rates. So over here, this chunk of words summarized into a couple of tables, okay, charts. Number one, household wealth continue to go up lah. Okay, while the rate of increase is not as high as it was in 2021 because that's kind of correlated to the sharp spike in real estate prices. This is quite a good one. I always refer to this one. So this shows the cash versus household debt, and notice that gap opening up more and more, right? I like to say Singaporeans, two hobbies, right? Save money and buy property. As you can see, ever since 2013, the institution of ABSD, last time they don't keep so much cash because they got money, they just buy property because they can leverage 90%. But now you cannot buy anyhow buy anymore, right? ABSD is so high, so what? They continue to save, save, maximum buy 2 then continue to save. We are essentially in a net cash position, so all the cash available in the Singapore real estate market, they pay down all the debt, they still have spare cash. Again, another reason for the low correlation between interest rates and property prices, okay? So here the Singapore personal saving rates remain high relative to its long-term average, right? So 34.6%. People save 34.6% of their income. Over here, so this is for the ones that like to wait for fire sale units. So this one, conclusion is you can wait but the percentage is over here. Non-performing housing loans 0.2% of all the transactions, okay? And the 10-year average is 0.3%. Basically, if you want, you can wait but chances are not very high, right? So while more households face higher debt servicing costs, the impact remains manageable. Before the cooling measures were instituted in 2013, the Singapore real estate market, Singaporeans only took up about 65%, less than 70% of the market. What that means, right, is that we are very susceptible to external shock, and also because inflow and outflow of funds dependent on interest rates. Interest rates are high overseas. People move their funds, sell their property, move their funds overseas. So the higher the percentage of non-Singaporean participants in the market exposes the real estate market to more external shocks. That's the conclusion. And ever since 2013, notice, right, that the percentage of Singaporean participation in the real estate market start to go up. Right, non-resident demand has fallen with the increase of foreigner ABSD. So all in all, this trend shows that we are more sort of self-sufficient in terms of our real estate market, more protected from external shocks, primarily cushioned by the cooling measures. And so here's the outlook, right, and the summary of the households are in healthy position, right, but should manage their debt prudently in view of the heightened uncertainties ahead. Similarly, that is most of the developers are concerned about. And if you were to really want to read, probably you can read this part if you have some concerns about interest rates and mortgages, right? Because this is what they really dive into, and they have some pretty interesting data points. They break down, okay, 40% of all the mortgages are on floating rate loans, 30% are on board rates or fixed deposit rates, and 30% are on fixed rates, right? So we see over here 70%. So this is the key difference between the 2022 Financial Stability Review, which have a general, the tone of which will be like, you know, we gotta wait and see on the pass-through rate, right? Pass-through rate means like, because there's sort of a delay between the rise in interest rates and versus how it's actually felt by the Singaporean households, especially for those on fixed rates, right? They need to wait for the fixed rates to lapse before they actually feel the increase. So in 2022, high percentage haven't yet feel the pass-through, right? But now 70% already feel the pass-through rates, and what MAS is saying, they are weathering it pretty well. So this is the percentage breakdown. So 30% fixed rate. So 60% basically 60% of them are on this kind of rates that don't fluctuate as much. Only 40% of them are on floating rates that are more exposed to fluctuations. Okay, so the household sector has weathered the rise in the mortgages well. Some pretty good data as well, because you have seen over here, right, total monthly debt repayment as a share of income for households for new mortgages have been relatively stable, with the median at a healthy rate of 43%. So what that means, right, 43% of household income is utilized to service the mortgages. They're on the median level. So over here, quite technical, but you see here the total debt servicing ratio. So while more monthly mortgage installments for new loans have increased significantly as expected with the increase in interest rates, but overall it's still a very healthy total debt servicing ratio. So what MAS stipulates 55%, the average is only at about 40 something percent. So this is another one, right? And this one I think maybe we can illustrate it using the charts over here. More than half of the mortgages have less than 20 years remaining in the lease, which means that Singaporeans are paying up a lot of their loans. And this one is quite common sense also, okay? Basically, the lesser the years, in terms of the loan, right, the lesser the outstanding loan, right, quite naturally so. So this one I think is not bad. It's quite a good correlation between increase in income versus increase in mortgages, okay? So MAS conducted a simulation to assess the debt servicing ability of households, okay? So first scenario, assume that face a higher mortgage of 4.5% in 2024 upon the refinancing of their previous rates. So they will face an increase of $790, about 7.5% of their income, but incomes have risen 10%. So which means income risen more than the mortgage increase, so that they should be able to weather it pretty well. Next up, right, they use a more serious scenario, okay? Interest rates go up 5.5% alongside a 10% loss in income. So this is quite a scary or quite a strong stress test. The results show that households would be able to still service their debt even under such stress, although a small segment of highly leveraged ones, right, this form about 5% of total mortgages. Yeah, so you see MAS, they really go through very stringent stress tests and just to make sure that do we need to do more cooling measures and whatnot. Is the Singapore market over leveraged in that sense? So they have all these data points that they're consistently tracking on a year-to-year, month. I don't think they do it on a yearly basis only, right? They do it on a month-to-month basis to see if they need to do anything to it. And so here's the sum up for you to read. So the degree of stress arising for potentially higher for longer mortgage rates vary according to the loan profile of borrowers' characteristics, right? While relatively newer mortgage accounts could face greater debt servicing stress from higher and larger outstanding loans, but the risk of default remains low. And that basically sums up the entire Financial Stability Review. If you really are the kind that likes to read this kind of stuff, you could. If not, I've sort of summarized it up for you. Really good for us to build fundamental understanding from the market before we head into 2024. Coming into 2024, there's perhaps two pieces of news that will have the biggest impact on the real estate market in Singapore moving forward. The first of which is our best friend over here. He can be your best friend or worst enemy depending on who you ask, right? Mr. Jerome Powell, and that one thing that he controls so hard, interest rates. Okay, and so the common consensus on the street is that the Fed will taper off, or at the very least stop increasing interest rates, and likely to be the second part of the year where they may look to cut interest rates. Of course, nothing is really set in stone yet, but I guess the overall consensus, the overall sentiments have shifted from the narrative, right, in the late part of 2022 coming to 2023, where there were multiple rounds of hikes, to now there's a little bit more stability and the likelihood that it may come down. So if you followed the channel, there's a couple of things that interest rates impact the real estate market. As we've spoken about earlier on in the video, the direct correlation between interest rates and the real estate prices, as opposed to, let's say, 10 to 15 years ago, is not that high anymore, the direct correlation part. However, interest rates have an impact on sentiments. So now that's the first point, that a slight shift in interest rates will impact the real estate market. It is sentiments. So with interest rates coming down, likely to come down, and sentiments likely to take a change, now that's going to have an impact on the market. So I'm going to give my predictions later on in the video. Now on the second point about the relation between interest rates and the market, it's opportunity cost. With interest rates at 3 point something right now, fixed deposit rates, T-bills, the savings bonds, SSB and whatnot, a lot of the 500 over billion, 600 over billion dollars in cash is now sitting in this risk-free and no effort sort of investments. Now what's going to happen to the market should that come down, right? Where this kind of risk-free, sort of almost risk-free and little to no effort investments don't look that good anymore, especially if they can't beat out inflation. Where will Singaporeans channel their funds into? And with higher for longer interest rates having a negative impact or negative sentiments towards the stock market, where will all these funds move towards? Now that's going to be the biggest question for 2023. And of course, lastly, and this has been something that we've been drilling on a lot on this channel, multiple videos, would be the stress test interest rates. And I believe that will be the single biggest impact of interest rates versus the real estate market. When stress test interest rates come down, as we would expect with SORA coming down, pegging to the Fed interest rates, I personally feel that would have the single biggest impact on the real estate market, and likely a positive one. My conclusion from this is that 2024 may be a year of two halves, really depending on when the Fed really starts to cut their interest rates. And the next piece of news coming to 2024, and perhaps one that has somewhat flown under the radar a little bit as compared to interest rates, is the likely general elections. And not just any other general elections, it's the handover of power from Hsien to Lawrence Wong. I'm not sure if you can remember the last time a handover of power was done. That was in 2004, just nice 20 years ago. And I sort of found a little bit of interesting trivia thanks to our good friends over at Google, right? Google's AI. I went to Google and went to Bud to ask them about, what happened in the real estate market in 2004. That was definitely before my time. And I found some pretty interesting similarities between that period of time and where we are today. So the first similarity is that both of these periods were the end of pandemics, right? So in 2024, Singapore was just coming out of SARS, and we all know over in 2004, we were just coming out of SARS, and 2024, we were just coming out of COVID. Interestingly enough, the real estate markets were quite similar at that point. So now if I'm going to read out what's happening during that period, it will sound quite similar to what we are seeing in this period today. So if we zoom in and we read this out, right, the Singapore property market in 2004 was characterized by slow growth and slightly downward trend in prices. Of course, on this part, probably not so similar. This marked change for the years immediately preceding, which saw robust price growth, right, circa 2021, 2022, right. Here are some key points to understand about the market in 2004, right. Prices overall mild decline, right. Transaction volumes subdued, right. Remember what happened in 2023. Factors influencing the market: government cooling measures, right. They had to introduce several rounds of cooling measures to moderate prices and prevent overheating. Tighter restrictions on lending and rising stamp duties. Hello, very similar, right, to whatever we are seeing right now. Global economic uncertainty, right, coming out of SARS and other factors, okay? And oversupply in certain segments, of course, on this note, not that similar today, but in the overall vibe and, narrative of the whole thing, does it not sound very, very similar to 2023, 2024? So I just found that to be pretty interesting. And if you want to see where prices were at, so over in 2024, so this one, of course, take it with a pinch of salt, right? But if you see the similarities on that side, then you want to borrow some of the, foresight from before, after which, we went on quite a good upturn, right, as Singapore exited SARS and as we went through a round of economic restructuring and the economy went up pretty well. So on this note, hopefully we follow it, right, but hopefully not this part, 08, 09, come the Great Recession. But why did I put this general election handover of power as, the second biggest piece of news after interest rates is that the Singapore real estate market, so it's not that, I want to discuss politics or anything, right? No. But the one thing that we can't run away from the Singapore real estate market is government intervention. We are probably one of the most intervened real estate markets in the world. So as we can see over here, in terms of LTV, we have 6 rounds of LTV interventions already. In terms of ABSD, 5 rounds of ABSD intervention, 4 rounds of TDSR and MSR intervention in the market. So all this intervention is with the general idea and general direction of not wanting runaway real estate prices, and that's all the more important during this period because they don't want runaway prices, especially when we are going to enter into such a significant period in time, especially in terms of politics, especially in terms of power, so to speak, right? They want a smooth handover over into the next 4G government. So now that's my reason why this, in my opinion, is the second most important piece of news coming into 2024. And that brings us nicely on to our next point. The 3 things that worries me in 2024. Now, the general worry coming into 2023 was the likely recession that everybody predicted and the potential job losses that comes with recessions. I guess that concern has somewhat subsided together with the fact that, the Fed has come out to state that we potentially will come into the soft landing, the all elusive soft landing, which is why they have changed their tone over to increasing interest rates to now tapering off and potentially dropping them. So now, with that concern having eased, we have a new set of concerns coming into 2024. So like I said earlier, in the second big piece of news with the leadership handover and potential elections, should prices take a sharp spike, as I predicted that they will take, should interest rates come off quickly, the government may be forced to step in to cool the market, which is my first concern, the likely chances of cooling measures should rates come off and prices take a sharp spike, because fundamentally the market, people are making more money, as we have seen in the MAS Financial Stability Review. People are sitting on a lot of cash right now that's parked in risk-free, effortless investments that are yielding pretty decent returns. Should that come off, demand will then shift to other asset classes, of which property we know it's Singaporeans' favorite. The reason why I foresee a sharp spike in prices should that happen, okay? So now, with demand being somewhat consistent, not having been taken off the market, demand is consistent, probably coming up should rates come down. So now if we look at on the supply side, while supply of new launches may look like they are coming up, we can see over here, supply of new launches on a 10-year average is still very, very low. GLS have come off a sustained period of undersupply, and over in the new launch market is still undersupplied. And if we then take a look at other forms of supply which comes in the resale market, right, we have eCMOPs, right, which is a good supply, especially for the HDB upgraders. In 2023, there was 4,100 ECs that hit its MOP, and that number is going to drop off significantly in 2024 with only 3 ECs expected to hit their MOP. We have Inns Residences in Choa Chu Kang, we have 100 Palms over in Serangoon, and the last one is North Wave over at Woodlands, right, contributing just 1,300 units. So that's a significant drop-off in eCMOP supply for the private residential market. Next up, we have the private TOP market. So these are new developments that have just collected their keys. Over in 2023, we have a bumper crop of 14,000 of them, and that's going to come off into 11,000 expected for 2024 and continue on that downward trend all the way to 2026 with just 5,000 to 6,000 units. So now all of this is going to squeeze the private market of supply, and so that supply squeeze has been there for the last 2 to 3 years, and as we have seen in 2021, 2022, that has caused a spike in prices. That demand supply imbalance is somewhat well managed, right, with demand being held back because of the increase in interest rates. Now with interest rates likely to come down and on the back of undersupply, this then reinforces why I say if not controlled well, and if rates were to come down sharply, demand will spike up and supply just cannot match up in time. Like I've always said, demand can be controlled easily, right? Pump cooling measure comes, demand can be controlled. But supply cannot be controlled that easily. You don't build a house today, you're not going to get a house until at least 4 years later on. The government have already sensed this happening, which is why they've been trying to ramp up GLS supply. But whether or not that is in time, time will tell. Okay? Now, the third thing that worries me is the lower land bids, the low number of land bids, be it the amount of developers bidding for the land, and secondly is the land prices. Okay, so low number of developers bid, chances that the land prices will continue to come down is a real concern to me, right? But like I explained earlier in the video, that's on the back of 13% year-on-year increase in construction costs. We also have GFA harmonization. Now, it's going to take time for the market to sort of get used to this and to understand this. So time will tell, especially with the launch of the first couple of batches of developments in GLS, right? First of which I believe should be Jalan Tembusu, Plot B, the one across Tembusu Grand, one of the first developments to launch post GFA harmonization. That would be one of the interesting data points that I will be looking at to sort of tell how does this whole GFA harmonization thing play into the final consumer, how much developers will launch the developments of that. Low land bids, you know, something of a concern but not overly big, especially if it turns out that the developers are just passing on all that cost over to consumers at the end. But if not, if the launches were to continue to show a reducing land price, a reducing PSF as compared to a close competitor, that will be something that concerns me in 2024. Next up, here are 3 data points that I will be monitoring closely in 2024. Number 1 is the stress test interest rates. What are the stress test interest rates for those of you who are joining us only on this part? The stress test interest rates are the interest rates that the banks utilize to evaluate your TDSR. So while MAS has stipulated 4%, the current bank stress test interest rates hover at 4.5, 4.7 or 4.8% depending on which banks you go and depending on what kind of properties you buy. And I have consolidated a table to illustrate to you the impact of a slight change in these stress test interest rates. I'm going to pull it up again for the benefit of those of you who are just joining us on this part. Assuming you have a combined household income of $10,000, right? If the banks were to adjust their stress test interest rates from 4.7% down to 4%, right, you're going to have a bump of $130,000 in your budget. You can take additional loan and then that's the increase in budget that you will have. If you have a combined household income of about $22,000, you're going to have a bump of budget of $270,000. So as I mentioned earlier on in the video, this is the biggest and most important data point that I'm monitoring, because should this stress test interest rates drop, everyone across the board is gonna see a bump in their budget, and that difference between the seller's asking and the buyer's budget, right? Should the buyer's budget get bumped up a little bit, and as that gap narrows, one of the buyers, right, some of the buyers were bound to just bite the bullet and make that jump up, and once a buyer will create a seller will become a buyer, and so on and so forth, and that triggers the start of the new upturn in the cycle. And that brings me nicely to the second point, which is HDB resale price index. While this is the best data point that I can monitor, there seems to be a small disparity between the resale price index and what is happening on the ground, to be precise, right? Especially now that HDB is starting to split up the supply in terms of 5-year MOP and 10-year MOP units. So, you know, they probably and they might have to make some tweaks in terms of how they calculate this resale price index, because that may not have a direct impact or direct reflection and accurate reflection of what happens. So to give you an example, in this year's market, if you were to go to somewhere a little more central, prices are still on the uptrend, pretty stable, or on the uptrend. But if you go to somewhere in the more outskirts area with supply being a bit higher, especially the MOP supplies being a bit higher, you do notice prices either maintaining at a level or dropping off slightly. For those of you, while this is the best indicator for us to take a look at, it kind of really depends on which area you are at. But now, why do I still take a look at it if it's not, you know, the most reflective of them all? I want to see if the price index really will take a dip. Okay, if it doesn't take a dip, then I think in terms of the upgraded demand, so to speak, especially for the first half of 2024, will probably mirror quite closely to what we see in 2023. But once this price index takes a dip, and let's say takes a dip over 2 consecutive quarters, then that may bring us back to the days of Hsien here in 2018, 2019, where private hits up and HDB prices hit down, and that will sort of create a reverse FOMO phenomenon whereby HDB owners then start to rush to let go of their HDB because they feel their HDB prices are coming down. Right now, they don't have that feeling because prices have been somewhat moving in the same direction, right? So once, if it were to start to dip off and private continue to go up, then that will create a little bit of FOMO effect for the HDB upgraders. Then that would sort of perpetuate uptick in the price movements over in the private sector. Next up, one of the third interesting data points, it's the new CCR DOB supply performance, right? Case in point, our friends at Leiden Green, Copa, for example, these are the first batch of the new launches in the CCR that came up 2 to 3 years back. They're finally hitting their DOB, and right now it's where, right, it's the true litmus test, the value proposition on such units, okay? Because the sort of the narrative during their launch at that point in time is because everything else, the prices have gone up, CCR has been somewhat stagnant and moving sideways, and so that this gap is getting wider and wider, and eventually, you know, people are going to realize it and then jump into the CCR market. I still very much think that there is still value propositions in the CCR market, but then again, like I said, the CCR market is not created equally. The supply into the CCR market is a lot more diverse as opposed to the supply in the OCR and the RCR, so you have to pick correctly. The reason why I'm monitoring that data point closely, especially the profitability of those units, is because this is the first time we're gonna see, you know, while one beda's 300-400 square feet we've seen before, right? Two bedas at 700 square feet, especially in slightly larger size developments like Leiden and Copper. We have 900 square feet, 3 bedas, 1000 square feet, 3 bedas. This is one of the first few times you're seeing this kind of supply come into the CCR market. Supply that have been very well received and performed very well in our OCR and RCR market. Now, would that translate over into the CCR? Now, that's something that I'm very, very interested to find out. Okay, and next up, right, since we are on this table, I'm going to share with you a little bit of the data, and we break it down into this chart, right? You can notice post 2015, the OCR outperformed everyone else. You can see over here it rose up pretty high. But in the last couple of years, it was the RCR that outperformed. And perhaps let me share with you a little bit of the change in data that can sort of correlate to this change in price performances for the areas. Notice here, this is a table of the private residential supply by expected year of completion ranging from 2016 to 2020. Notice over here very little numbers in the CCR, primarily in the OCR, okay, 60%. And you can draw the correlation once a lot of new launches come up in a particular area like the OCR, then they tend to outperform in this period, tend to outperform the rest. Now there's a change. Right, we see over here, the TOP from 2023 over to 2027, the chunk of supply is then going to come in, still in the OCR, but that split now has shifted quite a fair bit over to the RCR and also the CCR, with RCR picking up a lot of that numbers. And this, I feel, is one of the key reasons why the OCR has outperformed the OCR, with the property price index primarily pushed and led by new launches. Okay, so now with more and more CCR launches coming its way and TOPing especially, hopefully we may see a slight change up in this direction. It's sort of going to bring a lot of attention and a lot of self-fulfilling kind of conviction into the CCR market. And here are the 3 launches that excites me in 2024. But first of all, I need to caveat that these are the lists that I currently have based on the sites that have been en bloc or have been sold via GLS. It will not include those that have not yet been sold. I have another list for that. Basing this off also based on the fact that it's price aside and layouts aside for now, okay? And I will definitely be doing a review for these 3 sites. So you may want to put into the comments if there's any of the launches, upcoming launches in 2024 that you would like me to review, you know, in my traditional 3 things I like and 3 things I don't quite like manner. But these 3 don't need to put it into the comments, for sure I will review, okay? First and foremost, it's the Toa Payoh GLS. I've always been a fan of the Toa Payoh area, blue chip area, so to speak. Mature town, not a very high number of condo supply in that area. If I can remember correctly, should be just 4 existing one, and this should be the 5th one. And considering the fact that this is perhaps the better plot in that vicinity, right, with Gem Residences right across the road. Gem Residences, the sales were not that good during launch because of the fact that it was beside the temple. So this plot doesn't have that issue and it's actually closer to the MRT. So very, very excited about what's in store for this plot, as well as the developers. We have the very good developers CDL, Frasers and Secrecy worked on Seaside Residences together. They put that off pretty well, and then now adding on to another old-timer CDL and good size development at 800 units, okay? So it's also going to be anchored down by good school, right? I believe we will have one of the CHIJ, the top CHIJ Toa Payoh, and we're going to have Peichin as well. Expected launch price about 2.4 to 2.5k PSF, which is basically this year's RCR pricing. Right, so if they launch at around that pricing, I think it's going to be a really good deal, something that you guys can consider. Next up would be the Tampines Avenue 1 site, one by CapitaLand, UOL, and Hsien Land, again the big boys over here. A couple of things I like about it, okay? Number one, 1190 units, very big size development, very rare, quite rare nowadays to have so many units in a development. Another reason, okay, is this, the low estimated break-even, but bear in mind this is a number that's derived from HPROP. When it comes to this sort of mixed-use integrated developments, so to speak, not so easy to come up with the break-even lah. But if it does come out to be somewhere along these lines, meaning they can potentially launch at 2000, 2100 PSF, and I would think that's a very, very good deal considering its size, considering the fact that it's surrounded by a lot of new BTOs and all those 5-year MOP BTOs. It's essentially a new town. For all intents and purposes, this part of Tampines, for if they were in any other part of Singapore, right, they could have formed basically a new town on their own. HDB, just because they don't want to go into the effort of marketing a totally new town, they want to borrow the fact that Tampines is already so established, they just put it like, as part of Tampines North. Okay, so 1190 units, basically that's the biggest reason why, I'm paying attention to this particular plot. Next up, we have Chuan Park, okay? Long time in the making, they undergo a lot of issues with the strata board and whatnot, right? So this one, the developers, Kingsford, just a couple of years back, I would have concerns whether or not they could have pulled off the development, but I think they sort of turned the narrative around with their excellent execution of Normanton Park, so I don't think the Kingsford name is going to impact that so much, right? Again, very, very anticipated launch, right? The former Chuan Park. Again, it's also because of the number of units, 916 units, and the Lorong Chuan area hasn't had a new development there in quite a while. So this is the other launch that I will be paying a lot of attention to, and these are the 3 launches that really excite me in 2024. And here are my top 3 picks of the GLSs in 2024. And for pick number 1, it's going to be the Zion Road Parcel A. So this is likely to be a residential development with commercial at level 1, so think like Piccadilly Grand, that sort. Not exactly a full integrated development with a mall below, but what's exciting is the fact that there's going to be a 1170 units, perhaps the single biggest development in terms of number of units, right, in and around the River Valley area and connected to Havelock MRT. And it's going to be walking distance to Great Wall City. While it's not Great Wall MRT, but this distance not too far off, right? It's going to be just one bus stop down to Great Wall City. If you are already on site, this is actually a very short walk, very good distance. It's actually quite nice, close to the amenities over here, not too far from Tiong Bahru as well. So in terms of actual stay, right, while I'm not so sure about if those two atas, a bit snobbish people will think that, hey, well, this is a bit close to the HDB, right? But to me, I actually do think this is a lot more convenient as compared to, let's say, you go a bit further up into the Martin area. Of course, more atas lah, right? Not so close to the HDBs and whatnot, but to each his own, right? But why did I pick this as one of the exciting sites that have my attention, that I'll pay attention to? This is the first, likely to be the first of a series of land sales to happen in and around the new Great Wall MRT station. The government has been very strategic to launch all these plots only after the MRT has opened. This definitely is going to be more popular than this plot that's also up for sale, primarily because this one, it's very thin and north-south orientation, so it's going to be very tough for the developers to build. If they build this way, everything is east-west, it's going to be terrible. If not, they have to build like that. It's a bit tricky, okay? This will be more popular. Again, the government very smart to sell this one first before selling this one, because this one is easier to build, north-south orientation, okay? And if you zoom out a little bit, they will likely sell these plots first before activating the land for sale over here. Here we have the Irwell Hill, but here is an empty plot with the international school moving out. There's plenty of plots around here as well. So they're going to wait for all these plots to sell finish, then they slowly start to launch here. I've talked about this almost 1.5 years back when I was analyzing the River Valley area. I actually preempted this from happening. I could find that link and put it down into the description or somewhere in this video, but very, very clear what the government's intentions are. And next up, right, would be all these plots that will be close to like 4,000, 5,000 PSF already. I do expect these ones to come in at 3,000 plus PSF already, and then this one will then come in at 4,000 plus, considering it's walking distance to Ion Orchard. Pick number 2 will be the Holland Drive plot. This one beside the newly TOP One Holland Village, right? And One Holland Village Residences that's going to TOP, I believe, sometime next year. And so this one is going to 680 units. When One Holland Village first launched, take-up rate was not very good lah, because of the price point that Far East priced it at. But you know what? Till today, still pretty much fully sold already. And if you compare the prices with the launches in and around the market right now, it actually do look like it's not that bad a deal after all. And what I think might happen, I believe Far East may put in a bit over here so that they sort of have a monopoly over the Holland Village area and so merge it a little bit quite nicely. And if Far East wins that, then you don't expect the plot to be sold for cheap already. I mean, I do think this will be quite a hotly contested site, but then I think if Far East wins, then all the more you're not gonna get it for cheap anymore. And the third one would be the Bayshore plot, the first residential plot to be launched in the whole new Bayshore precinct. While this is not a confirmed site, it's under reserve site, word on the street and the experts' opinion is that this will then be triggered quite soon. They predict it, right? So, you know, this one will be very popular. Why? Because number one, sea facing, sea view. And if you look over here, the most immediate previous launch in this vicinity was actually Seaside Residences. And for those of you who follow the channel, you know we reference Seaside Residences quite a bit, and especially because how profitable they were. And now this Bayshore plot a bit further down the road, similarly sea view, albeit Seaside, District 15, this is District 16, but this is smack in the middle of a future transformation as well. A lot of HDBs coming up. And just one MRT stop down, not a lot of people know about this, but this color means it's going to be an integrated development over here. And that's really then going to bring up the attention and bring up the liveliness of this whole area, because if not, in the absence of which actually there's a bit of a lack of amenities for an area with so much residential units lah. But yeah, exciting times beckons also for the Bayshore area. And here are some of the opportunities that you might want to consider in 2024. I start off first with some of the gaps that I observe in the market right now, which is, I believe, in the upcoming years, the new launch market, especially for the 2+ study, 3 compact and 4 bidders, will be extremely profitable. The reason being that especially you need to see the gaps between some of these developments. Some of the newer 2+ studies, depending on the layout, I believe they will sell as 3 compacts in the future. And if you spot some areas whereby there are not that many 3 compacts to serve the entry level 3 bidders in a vicinity, those are also very good gaps lah to fill in the market. 4 bidders, right? Then you just have to analyze existing supply of 4 bidders in the area. What kind of sizing are they? Are there a lot of supply there? Most likely, the answer is no lah for those, right? And if you know you can get a new launch 4 bidder in terms of quantum at the same price, I think that's quite good already. If it's even lower, it's all the better. So these are some of the gaps that I will observe in the market, and you know, pick some of these units up for yourself. 99 years leasehold landed. So I thought really hard about, you know, whether or not to put this inside, because I must confess that, right, I was not a fan of 99-year leasehold landed for the longest time. I believe you check out my previous videos, I've always said, you know, if you want landed, buy the freehold one. But, right, in recent times, I have noticed that not just, you know, some of even the older 99 leasehold developments, case in point, your Mandarin Gardens, your Neptune Court, Laguna Park, those 30-40 years, Pine Grove 30-40 years, their prices are still edging upwards. And I'm surprised to see some of those prices in your Laguna Park 3 bidders even crossing the 2 mil price point. And then I see some of these leasehold landed properties that are not even nearly as old, right? That are offering, you know, I've seen some in the District 16 area, 3,000 3,000, 4,000 plus square feet built up. It's not even strata, you can tear down, fully rebuild, right? 2.8 million, 2.7, 2.6. I do see, right, that this 99 years leasehold landed will start to move up to fill the gap. So new launch always will take the lead, right? Followed by, you know, the rest of the 99, generic 99 years and generic freehold developments. Then the older 99-year leasehold developments. Then your freehold landed. And of course, the time the circle of the market has come for the demand to flow back, because the 99-year leasehold landed units really has been lagged to a lot of all these moves, right? So something to really consider. And you know, if you're concerned about, I buy now, then next time still can sell or not. I guess in recent times, there's also a lot more data to show that if the price is right, despite the lease decay, right, there's still going to be demand for it. Just remember this point, that demand in the market is not homogeneous, right? Demand is a lot more price sensitive, so to speak, right? And at the right price, there will still be buyers for your unit, right? Next up, the new versus old supply. I wouldn't dive into this too much, right? I talked about this a lot in 2023, and I believe will still apply in 2024. But just a very quick summary of which is that, you know, if you go into a certain area whereby the new supply or your newer supply, right, it's a lot more expensive. Most of the time it's freehold, slightly larger developments. Case in point, District 15, CCR, D10, D11. The older layouts, bigger in size, 3-bedders, 1,300, 1,400 square feet freehold, so quantums are large. Alternatives will be, you know, old 99-year developments that are still performing well. Make sure you check those out. They're still performing well, right? It goes to show the sheer demand in the area, and if you can pick up something that serves the in-between, 900 square feet, 1,000 square feet, 3-bedders, 99 years, be it new, be it sub-sale, so to speak, you know, then there's a good move upwards, because I've studied all these 99 years old developments quite a fair bit in 2023, and I'm surprised to see a lot of them still doing well. And you know, if they do well, you can tell yourself that, hey, this area, the demand is good, and so you know, you can pick up something that in between there. It's quite tricky. Some of the prices have came up quite a fair bit already, and if they come too close to this or too close to 99 years leasehold landed, they may be a little overpriced, so be careful about that, right? So those are some of the gaps over there. Secondly, it's low land price launches, okay, which early on in the video I've picked up some of those. Right now, land prices have sort of taken a dip, and I believe they are picking back up. So the GLS next year should pick it up together with consensus interest rates and whatnot. So some of those launches, if you can catch those low PSF ones, will be a really good opportunity for you. Now, as with next year 40 over launches, right, there's definitely going to be a lot of hype over those launches, but don't forget to pay attention to some of the post-launch units, some of the balance units. Remove that connotation that, you know, so good, why not sold, okay? Strip that aside, remove the emotions aside, just be objective about it, especially if sentiments start to move for next year, right, 2024, and there's a lot of FOMO into the newer launches, and especially because some of the launches that's happening next year, very, very good. You have your, you know, Toa Payoh, like I mentioned, you have your Tampines, you have also your Clementi, you have Pine Grove, all those quite good ones that will attract a lot of attention. But you know, there are still some good value buys in the post-launch markets, especially the slide that I shared earlier on those that didn't catch the 50%, never crossed the 50%. Not all of them can buy, right? Pay attention, but don't forget about them, okay? Sub-sale, I believe there's still opportunities out there. Just be very careful with the kind of quantums that you're buying into. If you're going too close to the newer development launches, then you got to be careful, right? Especially if you're buying slightly larger units, you may be squeezed in terms of the supply. But if you're buying something a little smaller, and if you notice there's a lot of supply into that area, right, it can be a decent opportunity for you to grab something that is not sort of overpriced, above valuation and whatnot, where the supply and demand dynamics is a little fairer. Okay, especially if you're a buyer lah. Right. Next up, fundamentally strong CCR properties. Okay, so while the CCR, if you look at the price index, tends to be tapering down, if you go to the right areas, the prices are actually coming up lah. If you really go study, right, some of the PSFs is just nowhere near the newer launches in the OCR, in the RCR, right? You can still find freehold developments in terms of their PSF close to 2,000, District 10, District 11, some more within 1 km of good schools, right? So all this, I don't think they will go too far wrong. And especially TSF is so far away from the new launches, RCR, OCR, right? The quantums can't be that far off anymore, right? Maybe 1 to 2 years back, the quantums were still quite far off, right? But once the RCR new launches 2,500 PSF, that quantums will then be very, very close. So, you know, don't remove CCR altogether because the data doesn't suggest it, especially if you are looking for investment and you want to be contrarian to the mix, right? You can pick up some of these 3 and 4 bedders CCR, fundamentally strong CCR properties. What do I mean by fundamentally strong? A decent size development anchored down by good schools, quite simply so, right? Amenities or whatnot, not so important, right? That's what I mean by fundamentally strong in the CCR, strong resale transactions, that kind of thing. If you're an investor, you can pick up some of the 3, 4 bedders around there as well for the right price, okay? The only issue is sometimes quite tough to get right prices in those developments. But if, you know, buy for own stay, you just have to pay lah. I like to call it a term of musical chairs, especially for those in the, you know, your District 10 area within the good schools lah. It will just be one family that needs it for the address passed down to another family that needs it for address. And for those, if you can get anything remotely near valuations, you should just grab it already. Don't expect anything below valuation. Most likely you need to pay COV, and if it's not crazily high above COV, something that you can still consider. Okay, right? Resale around the areas with a lot of GLS happening is also something that you can consider. The Lentor area, I think it's already in the past already, right? Some of the GLS areas that I talked about just before, right? My top 3 GLS picks. You know, you can pick up some of the resale units in that area because the new GLS is going to bring a lot of attention to the area. You're front running it a little bit. Once the development launch, I believe everything else is sort of priced in already, right? But you know, if the GLS is launched and you pick it during that time, I think it's still early enough into that game lah. And lastly, again, ECs, right? As with 2022, 2023, still I believe is a decent value proposition. Still a lot of supply, especially in the MOP market, yet to be absorbed, right? So something that you can consider. Or even the newer ECs, right? You definitely end up better on the other side, especially because of the fact that you're forced to hold it for 8 years. You may feel that, wow, the PSF now for brand new EC also so high, but you know, the sheer amount of holding period will make sure that you come out better on the other side. And finally, my predictions for 2024. And before I begin, don't forget to put your own predictions down into the comments to qualify yourself for the $200 cash prize. If you want to qualify for that, also make sure that you like and subscribe to the channel. Okay, now let's get right down into it. So for my 2024 predictions, this time around I broke it down into a little bit more systematic manner into the sort of different segments, okay? Starting first off with HDB resale. This is one of the first things that differ from my 2023 predictions to my 2024 prediction. So in 2024, I do predict that HDB resale price index to remain stable, if not still continue to climb a little bit. And as I explained why earlier on in the video, reclassification of BTOs, right, with the 10-year MOP, the prime and the plus flats, is going to be a real game changer for the HDB market, which means in today's, because in HDB supply, right, it's either resale or new, but now in terms of new, right, they're split that down even more significantly, basically making HDB less investable in a sense. But on that note, right, it also means that it reduces the actual supply of brand new HDBs into the BTO market, because those that want to upgrade and want to turn it around quickly will not pick the new 10-year MOP ones, right? They will instead go into the resale market. So previously, my assumption that should BTO wait times drop, all the demand will flock back into BTO. That will change with this reclassification. And so with more demand buying into this central location HDBs locations whereby the newer BTOs will be under the prime and the plus rules, all those demand will continue to push HDB prices up and maintain it that way. But then again, if you're in a location that has high number of MOP units and also the new supply, it's also 5-year MOP, then that's where you need to be a little bit more careful, because then in those areas, right, prices may come down a little bit, because if buyers want to go into that area, they have quite a good alternative into just buying the newer BTO. Okay? Second prediction, HDB resale volume to increase primarily because we have not yet seen a spike in terms of the HDB resale applications despite the bumper crop of MOP units in 2022 and also 2023. The numbers basically has been all hovering around the same level. So I do expect that to increase, and especially if interest rates were to drop down, I do expect them to increase quite a fair bit as people then finally are able to get a bit more loan and to make that jump into the private market. In terms of the supply in the private market, I do expect it to be even greater undersupply in 2024 as opposed to 2023. First and foremost, MOP numbers have come down. Secondly, TOP's numbers have come down as well. So effective supply, right? Not to talk about the new launch supply, which then obviously has come up a little bit with this year having 40 launches, but effective supply means supply that you can buy and move in straight away. The numbers will actually come down in 2024 as opposed to 2023. And with sentiments then starting to pick up. So 2023, I think all in all, you could sort of describe it as somewhat of a buyer's market already, especially in certain areas. MOP ECs especially, right, with the sheer number of MOPs. But next year MOP numbers, EC MOP numbers have come down. I will see that dynamic sort of shifting back to probably a bit more balanced, especially in the first half of the year before interest rates come off. And once interest rates do actually come off, they may then swing back to being a seller's market due to the undersupply. Okay, and then the overall property price index to continue on its uptrend, because I don't foresee any severe in terms of demand, unless of course demand is hit. In terms of supply, it's still going to be relatively low unless external factors involved. But generally, if you compare 2023 to 2024, the overall sentiments seem to be a little bit more bullish in 2024 as opposed to 2023. But of course, nobody knows. So in the absence of which, I do expect to see the PPI continue to pick up, but probably not at the rate that we saw in 2021, 2022, right? Probably more similar to 2023. And if rates come off, then the rate of increase will be a bit higher. So now next up, CCR property price index, of course, because it's gone on a multiple years of being low or balanced off. This year, we're going to see the TOP of COPA. We have already seen the TOP of COPA, but you know, transactions slowly come in. We see more of it in 2024. We have Liden Green and a few more that's going to hit its TOP, and I believe those new supply being of a slightly smaller size, more affordable quantum, will start to drive property price index prices up, especially in the CCRs coming off a really low base. So hopefully then that would then bring a bit more attention into the CCR. Also thanks to the fact that we're going to have finally a little bit more GLSs in the CCR with our Zion Road, River Valley, all of which, should they then launch within the next year, push PPI prices up. The CCR, I believe, will continue to outperform, and outperform compared to who? Compared to the OCR and the CCR, right? Because of the sheer number of TOP units still in the RCR, and because of the fact that there's still going to be, in terms of the next couple of years, still going to be quite a fair number of developments to be completed into the RCR, right? The OCR, because of the launches and whatnot, and the price gap being quite near already and having seen a huge spike up in prices, I believe RCR will perform better in that sense as opposed to the OCR. Private volumes to increase, of course, primarily thanks to more launches happening next year. This year's base have really been quite low, so I do expect the volumes to sort of pick up a little bit more. And also next year, this year a lot of TOP, right? But the TOP, yes, there have been some transactions and whatnot. Quite a lot of them are surprisingly not out of SSD yet. So next year, more out of SSD, and I do see the trend happening a lot more come next year. And also waiting for sort of the demand to sort of come in, rates to come down, stress test interest rates to come down. So again, right, everything really hinges on interest rates movements. But sort of these predictions, assuming everything remains the same, of course, if interest rates were to taper off, then everything else, all of these predictions will then move at a greater magnitude. Landed price increment to ease, right? Landed prices have gone up quite a fair bit already. And actually, if you look at the charts, the landed prices and the condo prices, the gap is quite big already. It's one of the biggest in a while. So in that sense, the affordability for people to make that jump up to the lender, I believe, has slowed down. I've monitored the blended market a little bit, and actually I do notice asking prices tapering off a little bit. But asking prices tapering off does not mean prices actually do come down. It's just that owners then cannot ask for that high of premium above past transacted, that high of premium above valuations anymore. They are becoming a little bit more realistic as their listings on the market for a slightly longer period of time. So now what that means is that for those of you looking to upgrade to a landed property, a couple of things you can think about, right? Number one, don't be kanchong to do so, right? I don't think prices run away that quickly. Landed always is a bit laggard. So even if rates drop, the condo market has to start to grind and start to pick up its pace first before the landed start to pick up. The landed has really just picked up quite a fair bit in 2021, 2022. So now it's sort of tapering off. Condo need to catch back up before lenders start to move again. I do expect rentals to continue to stabilize. I don't expect it to drop too much, right? Primarily because of the fact that people have bought their houses at not that cheap a price lah. So they don't want to rent it out for too cheap. It's not like interest rates are going to fall off the cliff anytime soon unless anything happens. So people again, right, still have to pay their mortgages. Property tax has come up, so then they have to also make up for that cost. So there's going to be a baseline to which landlords can lower their prices. And if you've watched the video earlier on in the start, some of the rule changes the government have done in the rental market sort of hinting to me that they may potentially want to bring in a lot more people, right? Which is why they are doing all those slight changes to make sure that the rental market is well supplied before they open the floodgates to bring people in. But of course, right, 2024 may be the year that we have the elections coming in, so maybe they can't do that on a too obvious level. Last of which, if interest rates were to come down, especially the stress test interest rates, then you do expect sharp price movements upwards, primarily because of the fact that income levels have actually picked up. No recession, no widespread recession, widespread job losses, so fundamentally there's no wealth destruction, right? Wealth right now is primarily just being channeled over to fixed deposits and whatnot. And if you can see it from that way, it's all just stored firepower, right? Fire powder, just waiting for that slight ignition to happen and for all of that to kickstart the whole motions again. Of course, I don't hope for that to be overly drastic. If not, cooling measures will come in. The government seem to have caught their bearings quite well by trying to preempt that by doing a lot of slight tweaks here and there, pumping out GLS supply preemptively and whatnot. If not, then these are my predictions. Every year get more and more, so giving myself more and more chance to get things wrong, but hopefully not. Hopefully they are quite accurate, and so we'll see how I do 1 year from now. And as we come to the end of this video, I would like to thank you so much for your continuous support of the channel. For those of you who do support us over the years, right? Again, this is our 4th time doing this. And for those of you who are new to us, I hope the video has been beneficial to you. So if you're looking to do something in 2024 and you hope to have somebody just double check on, like, you know, how do you fit into these overall narratives I shared with you, some of all these opportunities, not quite sure what to do with all this information, feel free to reach out to us and we'll be happy to help you out. If not, wishing all of you a very happy 2024 and to a more successful 2024. Bye bye.